It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance Live. Well, we are nearing the end of the year, and here at Yahoo Finance, we like to take a look back at how companies have fared. In 2023, a number of companies dominated headlines, including NVIDIA, OpenAI, and FTX. But in the healthcare space, there was a clear frontrunner, and its drug advancements have proven far different than those recognized during the pandemic. Although this Danish drug maker may not yet be a household name, you've certainly heard of their products.
This is the most American story ever. Big Pharma created a drug to help Americans eat less.
2023 was all about one drug. The surprise popularity of Ozempic, a 5-year-old type 2 diabetes drug, along with the weight loss branded version Wegovy, makes Danish drug maker Novo Nordisk Yahoo Finance's 2023 Company of the Year.
It's a big change. I've been with the company for more than 30 years. I'm only the 5th CEO in a 100-year-old company. And suddenly we have brands that are becoming household names, and we've never ever had products that were widely known.
I think when we talked about Novo, it was really a company that had a product that became a verb of sorts this year. When people look at the celebrity world, they say, why is everyone so skinny now? The word that came to mind was Ozempic. At one point this year, they were the most valuable company in Europe. It really shows, I think, the primacy of Novo in being a leader in what I think most analysts expect to be really the future of healthcare coverage.
In order to be Company of the Year, Yahoo Finance determined that Novo achieved significant milestones in 2023. The company dominated the weight loss drug space with Wegovy and off-label Ozempic prescriptions. Novo's stock price has seen a close to 50% increase year-to-date, beating the S&P's nearly 20% return. And for the first 9 months of the year, Novo's U.S. sales grew by 46%, with international sales up 12% and operating profits climbing 31%. But increased demand has caused a supply shortage since late last year. It's why Novo is now investing more than $4 billion in expanding its manufacturing in Europe. And Novo is struggling to quash unapproved knockoffs being sold at clinics and medi-spas around the country. Ozempic and Wegovy are known as GLP-1s, a class of drugs that helps increase insulin and slow digestion. GLP-1s are not new. In fact, they debuted nearly 2 decades ago in 2005. But the 15% body weight loss achieved by the active ingredient semaglutide is new, and a key reason why Novo is currently the market leader. Plus, Wegovy could soon be approved to manage other health issues. Beyond healthcare, the drug could disrupt other sectors like food, beverage, clothing, and air travel if more people take the drugs, according to analysts.
Even if 7% of the U.S. population was on these drugs, that's a bull case scenario, by 2030, that would only lead to a roughly 2% decrease in same-store sales growth for restaurants. And many analysts saying that perhaps this isn't as disruptive as many had predicted earlier this year. Now, retailers that have pharmacies inside, think Walmart, think Kroger, think Costco, with more consumers looking to that pharmacy to get these weight loss drugs, that can actually provide a boost for these retailers.
Even Novo CEO Lars Jorgensen pushed back on the negative predictions.
My view is that some of those reactions are perhaps a bit exaggerated, but there's no doubt that with the intervention we see now with the GLP-1 based medicines, you see significant shift in consumer behavior, and some of these categories will be impacted.
Novo Nordisk and its drugs Ozempic and Wegovy have dominated conversations this year, going beyond the impact on healthcare space to retail, food and beverage, alcohol, and much more. Joining us now, our Yahoo Finance executive editor Brian Sazi and our health reporter Anjali Khemlani. Anjali, we got to start with you. I mean, you think about the landmark year that has been for Novo Nordisk here. What really jumps out as they receive the recognition and honor of Company of the Year here?
I think it's surprising for the company itself, I think, how well they did this year. You know, the demand outstripping supply by a long shot, them having to decide very late in the year to announce ramping up manufacturing. I wonder if they just maybe wonder that it might just sort of peter out, this demand, but it clearly is not going away. And I think that caught the company off guard. So it's surprising and I think good for them to see that kind of success.
And I'll just add here really quickly, one, hat tip to you, Anjali, Brooke De Palma, and our very own Ali Garfinkel and our team for putting all this work together. It's all on our homepage now. It's just awesome, awesome reads, very impactful, I think, to investors on really a stock like our very own Miles Eldon mentioned in the package has changed the dynamic across many industries. It's not just healthcare, it's food. That's what Brooke's piece now on our homepage looks at. And this is all coming from a company with a very unique operating structure, not really something we see from a lot of other companies. But in terms of what you're saying, Anjali, look, these two charts here from Jefferies really trying to capture, I think, the interest in some of these products here. Looking at search interest for weight loss products remains very high. It has trended up higher throughout the year. That's very strong. And you have to wonder, once more of these products hit the market, what does this do to the food industry, for example? You have to think it's going to have a huge impact.
You have to think it's going to have a huge impact, and we've started to see a number of analysts when it comes to what the street has been saying about the uptake rate of these, exactly what that is going to look like. It's really anyone's best guess at this point. But just a few weeks ago here on the program, we were talking to one of the analysts with Stifel, talking about the fact that they've already seen a lot of interest from consumers. That right around 15%, the consumers that they surveyed said that they do have an interest in this drug. An additional 20% saying that they would be interested when we get a little bit more information just about the efficacy of it, also the safety of it, some concerns there. And we also have to talk about price as well, just limiting some of that adoption. So we really are just, it sounds like, in the very early innings of this drug and what this potential could really look like.
Yeah, not just early innings in terms of uptake and the side effects, but we also don't know what the long-term use looks like, right? Things like Ozempic face have been top searches this year. We know that they have competition nipping at their heels, Eli Lilly being one of the big ones. And then others that are coming down the pike. What does that look like? Do other drugs take a look at some of these side effects, correct them, nausea and all of that? So there is, there are the negatives of what this drug have. There is the access problem. We know that insurers do not want to touch it because of the sheer volume of demand they're going to get and the number of people that could be on this. You're talking about the size, the volume, the market of a drug that has never been seen before, right? You're talking about half the population. What other drug do you know that has that market?
Right. Aspirin?
All right, guys, we have so much to get into when we're talking about the fact that we're just in the early innings of this. Well, our company of the year, Novo Nordisk, isn't the only player in the weight loss drug space. Eli Lilly also has emerged as a major competitor with its type 2 diabetes drug Mounjaro and its new weight loss counterpart Zepbound. We want to take a deeper dive into this competition, into this space. We want to bring in Lee Brown, Thurbridge, a global sector lead for healthcare. And we also have Damian Conover. He is a Morningstar's Director of Equity Strategy. Plus, we still have Anjali Kamlani and Brian Sazi here sticking around for the conversation. All right, Damian, let me start with you just in terms of the fact that you have now spent years covering this space, the excitement that we've seen around these new weight loss drugs over the last 12 months. Have you seen anything like it before?
It's really unique. We really haven't seen something like this. The drug development space looking at obesity drugs has been a focal point for decades. And we really haven't seen the efficacy until recently with Wegovy and subsequently Zepbound. So you're talking about the ability to reduce weight. Historically, you got sort of in that 5% weight loss. Now you're pushing into the mid-teens and even close to 20%. And that's a massive step change. And it's always dangerous to say this time it's different, but it really does feel like this time it's different for obesity drugs.
Damian, I'm so glad you brought up that point. It is different this time. It does feel different. And I've had others tell me that, really Novo could be credited with sort of creating this obesity market out of thin air. We know decades have been going into the R&D for this. Other companies left the field and then are pivoting back suddenly because of this new demand. Do you think that there's enough room, enough cushion for Novo and Lilly to sort of take over the market once again and go head to head before anyone else shows up?
It's a great point. I think the first mover advantage is definitely in Novo Nordisk and Eli Lilly's hands. They both have great drugs on the market that will really start the penetration. You think about penetration right now in obesity, it's around 2%, and that's very, very low. And you think about the ability of GLP-1 drugs, that's what Wegovy and Zepbound are. You think about their penetration rates in diabetes. If we can see that mirrored in obesity, you're talking about a huge rampway. And so I think over the next couple of years, this market is really going to be dominated by Novo and Lilly. But like you said, there will be more competition. We're seeing a lot of acquisitions take shape. Roche, Pfizer, Astra, Amgen, all these companies are likely going to be in the market, but not in the next couple of years, more like the next 3 to 5 years. And at that point, competition is going to probably bring down price. You'll probably see market penetration increase. But in the near term, this is Novo and Lilly's market.
Lee, just given where the market could end up here over the next decade, do you think Novo's stock is undervalued?
Can't comment on valuation. I certainly will say that these will be the blockbusters of all blockbusters. Consensus has these drugs going to north of 60 billion over the next five years or so. And as everyone on the panel has commented, that's going to remain a low penetration rate. So I think the future is very bright for all of these companies.
Lee, ultimately, just kind of to add on to that then, what type of additive in terms of growth prospect are you expecting for all of these companies? Is there kind of a multiple that you're layering on over the next year, 2 years, and where that demand curve moves from here?
Yeah, I mean, I think you folks said it best. It's anyone's guess in terms of the exact trajectory. What I will say is it's going to be harder and harder for payers to push back in a value-based care mentality. What I mean by that is we're trying to push costs in this country to the lowest setting. So stop having people come into the ICU for heart attacks or stroke or dealing with spine implants or AFib. Go ahead and address this obesity epidemic at its head. And look to future competition to drive down pricing. I think it's going to be very difficult for payers to push back on these drugs over the long term, even though it's going to be incredibly costly. I have some other thoughts on that, but I'll turn it back over.
Well, maybe this fits into what you were going to say, but I wonder also about, the prospects for Novo now as having been long just a diabetes company. We know they have other sections of their portfolio, but it has been largely just insulin and diabetes products. Now this opens the door for other sectors, maybe, for a more diversified portfolio for this company?
Well, one of the things I had a recent conversation with an industry expert, and I think one of the things really benefiting Novo is the fact that they have been in this space for some time. So they have a lot of goodwill built up with the prescribing doctors. And I think that brand comes a long way. I will say that Eli Lilly is a marketing machine. They're doing a bit of unfair comparisons looking at a higher dose of Mounjaro and Zepbound versus Ozempic and Wegovy back when that wasn't approved for 2 milligrams. And I think they're going to use those comparisons until there's a head-to-head to really pound the messaging through key opinion leaders and through direct-to-consumer marketing that Mounjaro and Zepbound have superior blood control and weight loss. And so I think it's going to be an interesting market as it heats up over the next few years.
Damien, do you see anything tripping up Novo next year?
I don't see much tripping up Novo. I think they're very well positioned. We have to get a little bit more granular detail on some of the follow-up studies beyond the weight loss that we've seen. The weight loss looks great. We've seen some top-level data on how well it works in renal impaired patients. That granular data might not be as good, but I think the data probably will be good. That's, one potential challenge, but I don't see too much tripping up Novo. I think, I think the market's so large that Lilly and Novo can both be very successful here. So I don't really think it's going to be a market share game in the near term. I think it's a market expansion story in the near term. So really in the immediate term, Novo looks extremely well positioned. I'd say only potential hiccups along the way could be potential side effects that we haven't seen. If you think about these GLP-1s, they've been on the market for a very long time, but they've been focused on diabetic patients. They really haven't been focused on overweight patients. So there theoretically could be some side effects. I think that risk is low. I think really from a fundamental standpoint, the sales trajectory is very solid for Novo.
All right, well, thanks to Damian Conabor and Lee Brown for helping us break down Yahoo Finance's Company of the Year, Novo Nordisk. Again, check it all out on yahoofinance.com. We have a number of feature stories up on the site right now. And of course, our thanks to Anjali Kemlani for leading the charge on this, and Brian Zazi as well. All right, well, Brian, stick around because we have another top story here that we're diving into, and that is Macy's. Macy's board is now mulling over a $5.8 billion buyout offer from Arkhouse Management and Brigade Capital Management. Now, the deal would value Macy's at about $21 a share. You can see it trading just around $20 a share here ahead of the open. The stock, since the start of the year, still in, let's see, off just about 15% year to date. You can see it closed yesterday. Closed Friday, I should say, just above $17 a share. For more, Brian Zazi is still with us. And Brian, when you take a look at this deal, you have been a close follower of Macy's now for quite some time. The retailer has really been struggling to gain traction with consumers, really capitalize on that loyalty program. What do you think about this offer?
Well, I should note, a source familiar with the matter telling me that this bid actually came on December 1st and represented about a 32.4% premium to Macy's closing price on November 30th. So this didn't just happen overnight. It is unclear where Macy's management team stands on this and where the board stands on this. Macy's declined to comment to me on this matter. I've heard that they are mulling this, and they have a lot to consider here because this is essentially would be a real estate play. If you look at the valuation of Macy's real estate assets on its balance sheet, about $5.9 billion. So this offer below that. There's been some estimates recently by Cowen in 2022 looking at the value of Macy's real estate close to $8 billion with that Herald Square iconic location you're seeing right there in those photos, valued at maybe $3 billion. So is this a great offer? Unclear. But on the other side of the coin, you have this view, and I was talking a little bit about this with our editor, Jennifer Wong. Is Macy's real estate value, is it overvalued? Meaning they had a good chance to maybe sell a lot of this real estate a decade ago, really at the top of the market rates. What is the outlook for some of this retail real estate, which developers normally don't really like and needs to really be repurposed and in some cases knocked down, completely bulldozed? What is that real estate really worth when people are, let's say, still working from home? They're not back out in these retail tourist locations buying things and driving traffic to the location. So lots to consider here. I think this is the early innings, and it comes at a really interesting time here, too, as the company has a new CEO coming into the mix early next year, and that's Tony Spring.
That's what I was going to ask you about. Is this a pre-transition referendum that we're already seeing on the confidence in Tony Spring coming into this role?
Well, I think this is what you normally would hear, an opportunistic offer. A company maybe flailing with a management changeover. And let's keep in mind, Macy's has done dreadfully the past decade. The sales have been poor, the margins have been poor. They've been very slow to close stores and monetize this assets. So a lot of the executive team at Macy's, who's been at Macy's for a long period of time, has done a pretty terrible job. Now, where they have done a good job is improving the merchandise assortment at these locations. But by and large, you talk to a lot of pros on the street, Macy's could probably close 300 more stores to better operate its business. It had close to 600 right now.
All right, Zazi, we're going to continue this conversation here this morning. As we're tracking shares of Macy's pre-market right now, they are higher by about 15% on news that the company is weighing a $5.8 billion buyout offer. The proposal comes at an interesting time for the retailer, smack dab in the middle of its critical holiday shopping season and just weeks away from a planned CEO transition. So, is the deal worth considering? With more, we're now joined by David Swartz, who is the Morningstar Senior Equity Analyst. David, let's start there. Is this deal worth considering for Macy's?
Yes, I think it is worth considering. I think there's a lot of risk if Macy's turns it down flat because you never know when these kind of offers will come by. Now, $21 a share is kind of low. It is lower than the value of Macy's real estate. But you also have to remember that Macy's has $2.8 billion in net debt. It has a history of very uneven results over the past 15 years, really. And the model at Macy's just doesn't work anymore. And so it really is important for Macy's to take this offer seriously and potentially try to get a better price for shareholders.
David, do you think this type of offer, because we're seeing shares in Nordstrom move higher on this, does this unleash a wave of activity for old school iconic department stores like a Macy's, like a Nordstrom that own a lot of real estate? Now we're going to see those buyers step up in here and putting in bids.
Well, that's very possible. We did see Kohl's go through a potential buyout process a couple of years ago. That did not end in a deal. And if you look at Kohl's stock price since, it's way below where it was at that time. It's far below the offers that were discussed. So I think there's potential that someone else could go after Kohl's again because it is, I think, quite undervalued as well. Now for Nordstrom is a family-run business, and the Nordstrom family does own 30% of the company. So I think that's less likely to be sold, but it is possible that it could be taken private.
Dave, when it comes to some of the uncertainty out there, you mentioned the fact that maybe this is more of a real estate play, just given the valuation and what we have seen. In terms of what are the other strengths, though, that could maybe make Macy's attractive to bidders? Is there anything else that you have on your radar, just in terms of Macy's? Yes, it's struggling, but it still has an edge because of XYZ.
Yeah, Macy's does have strengths. The company is one of the largest online retailers in the U.S. with over $7 billion in online sales. The company gets very little credit for that because people still see it as a brick and mortar retailer. Other parts of the business that are attractive include Bloomingdale's. Bloomingdale's as a luxury store does stand out from others. And it has been doing pretty well recently, which is part of the reason why the Bloomingdale's head is going to be the new CEO of Macy's very soon. Then you also have Blue Mercury, which does have potential and is growing. It potentially hasn't really been meeting what it could be. But, I think Blue Mercury in the future does really meet with a lot of trends that have been powering other beauty retailers like Sephora and Ulta. So I think Blue Mercury is also interesting. Then you look at Macy's. Macy's does have 40 million shoppers a year. It has millions of credit card holders. It does have strengths that people would be interested in.
Well, unfortunately, Blue Mercury was perhaps one of the only bright spots in the most recent earnings report on the comp sales perspective. On some of the downsides, Macy's comp sales down 7.6%. Bloomingdale's comp sales also down a little more than 3% on an own basis. And then you talked about the credit cards. Well, we started to see some delinquencies show up there as well. So what is the likelihood that without an acquisition, this Macy's company that we've come to know, shop at, some people love, make it through a recession that some are forecasting, at least economists that we've spoken with, looking for a mild recession?
Well, Macy's survived the COVID period in which its stores are closed. So my feeling is that if it can survive a disaster like that, then it can survive a recession too. I got a lot of calls at that time about whether Macy's would survive, and there are people who really thought it would go bankrupt. But at the time, I thought Macy's would survive, and I still think it will. The company will never be a hugely profitable company in the future because the department store model just doesn't work anymore. And that is why I think it needs to seriously consider this offer. Macy's doesn't seem to have a great plan for its real estate. Macy's has been under pressure from investors for years to monetize the real estate, and it has done some of that, but not to any great degree. And it certainly hasn't benefited the shareholders. So, I think that this offer needs to be considered because the reality is that Macy's will never be what it used to be.
And David, one wrinkle in this deal that a source pointed out to me is there's a willingness to raise this deal or this offer price of about $21 a share even higher upon doing some due diligence. Do you think $25 gets it done, or they need to get to around $30 to make a deal happen?
My fair value estimate on Macy's is $25. So, I think a $25 offer is fair. Macy's may demand more than that, and you could certainly argue that investors deserve a premium since it would be taken private. But, I think that any offer above $25 is certainly probably good enough for shareholders. And so I think that the idea that the investors have let themselves be open to a higher bid suggests that they know that this initial bid is on the low side and that they are willing to raise it.
All right. David Swartz, who is the Morningstar Senior Equity Analyst and Yahoo Finance's Executive Editor, Brian Sozzi. Thanks so much. Macy's shares up by about 15% here pre-market. Everyone, we've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. We're just inside of 5 minutes away from the opening bell on Wall Street. Let's get to Yahoo Finance's Madison Mills over at the New York Stock Exchange for a look at what's moving. Hey, Maddie.
Hey, thank you so much for having me this morning, guys. It's my first day here at the New York Stock Exchange, and I can't get away from the comments about Macy's, Macy's, Macy's. That is the story here at the New York Stock Exchange today. I know you've been talking about it all morning, but just to do a little bit of a markets check, this name was up over 20% this morning on that news of the potential acquisition that would take this huge name private, that to the tune of $5.8 billion. Now looking at this ticker, it's up about 15% this morning pre-market here. We still got about 5 minutes to go before the market open here. I also just want to talk about some other M&A news. It's not just the focus on Macy's. We also got to talk about the news we got this weekend with Cigna and Humana. Cigna saying that they're no longer pursuing that acquisition of Humana. The street is rewarding that because this deal was seen as too expensive and likely to face regulatory challenges as well because of the antitrust concerns with these two very similar names in the healthcare space. Cigna is up about 13% this morning on that news. And this comes after Cigna has been crushed year to date off of this potential acquisition that the street did not like for them. They were down 10% the day that acquisition was announced. So seeing a lot of movement in the M&A space today, guys, as we head into the end of the year here.
Yeah, Maddie, we certainly are seeing a lot of movement in the M&A space. Certainly those tickers here directly involved. We are seeing either pretty strong gains or losses here ahead of the open. But let's talk about, more broadly speaking, sort of the muted reaction that we're seeing, or the muted action, I should say, ahead of the open. We have a lot of very important economic data coming out later this week. What are you hearing from traders just in terms of what sentiment is like going into those reports?
People are waiting, right? Ahead of a Fed meeting coming up on Wednesday. We've got CPI this week as well. It's a big week for economic news, so there's going to be a little bit of hesitation, particularly after we had a pretty big day Friday. A lot of excitement on the street after those sentiment numbers coming in, showing that consumers are accepting the idea that inflation, the Fed might be winning their war in that fight, right? So seeing a little bit of excitement on Friday, but this morning, a little bit of hesitation as traders are just awaiting some of that big economic data to come this week.
All right, Maddie, thanks so much. Just again, we're just over a minute here until the opening bell, and taking a look at some of that action or lack thereof, really. We take a look at the major averages ahead of the open. We're seeing a slight movement here to the downside, indicating that we're going to open in negative territory. We are coming off, though, a string of very strong weeks here for the market. Lots of anticipation about the Fed potentially cutting early next year. You can see the market pricing in chances for a cut as early as March. The street, though, a little bit more, reserved in some of their expectations. We'll be talking about a new Goldman note in just a few minutes in terms of when they're expecting rate cuts. They don't see it happening until the second half of the year. But Brad, when you take a look at some of those individual movers here this morning, Maddie was just talking about a lot of excitement surrounding the M&A space. But what exactly that's going to look like going forward, I think a lot of that is going to be dictated by Fed policy, the broader investment sentiment right now, and exactly what companies see as some of those potential strategic alternatives here going forward.
Yeah, it's interesting, too. You're going to have a few earnings reports that kind of trickle out as we get towards the kind of last big trading sessions, I will say, because once you get into those last 2 weeks of the year, volume becomes extremely low. You've got less traders that are at their desks. And so that's where there could be a little bit more volatility. But typically what we're going to be watching for this week here as well, still some big software companies, I'll say, out there more broadly. Oracle is one of them that I'm going to be watching. That reports today, this afternoon, actually. We're taking a look at the market action here at the opening bell here. We've struck 9:30. Just crept up on us like that. Okay, it's 9:30 a.m. Eastern time. Opening bell just happening here. Let's take a look at the major averages. We've got them here on your screen. We are mixed. To begin the day, the Dow starts off the day higher by about 0.1%. The S&P 500, though, and the Nasdaq, they are down fractionally as they may be. S&P 500 down by 0.1%, and the Nasdaq Composite down by about 0.5% right now.
All right, let's get to our market commentary of the morning so far, and that's Goldman Sachs expecting a cooling inflation ahead, now updating its expectations for the first rate cut from the Fed to happen in the third quarter of next year. Goldman now forecasting 2 cuts from the central bank next year. They had originally just forecasted the first rate cut that we would see from the Fed would not happen until the very end of next year. So again, they're moving up their expectations just a bit on this. The reason why they're seeing some more progress here on the path towards cooling inflation. They see inflation core PCE coming down 2.5% range in 2024, down to 2.2% in 2025. Then looking a little bit further out in terms of some of their expectations, they see cuts in 2025 of about 125 basis points, another 100 basis points of cuts in 2026. And I think this just further illustrates Wall Street seems to be almost all over the map in terms of when the Fed is going to cut rates, what exactly that timeline looks like. And I don't think that you can blame them with the fact that a lot of the econ data has been a little bit tough to kind of siphon through and really figure out exactly what this means for the Fed's fight against inflation, how quickly they could potentially get back to that 2% target.
Yeah, Nomura did it right. They were just wrong months ago. So now at this point, we're looking out to next year to see where an actual cut does take place. Ultimately, one of the things that they did note, and I don't always print out the notes, but I printed out this one today, safe paper, why not? But at the end of the day, here, what I did note and kind of circle here, healthy growth in labor market data suggesting that insurance cuts are not imminent. Core CPI likely to print near 27 basis points on Tuesday. Wage growth still too high. Don't think that normalization cuts response to a decline in inflation or are either. So at the end of the day, kind of synthesizing what they're saying here, they're taking a look at the labor markets data that's come out and said, okay, that's still kind of hot. The Fed's going to be able to continue to lean on that. And even though the Fed is going to be continuing to be extremely aggressive, perhaps in cutting or fighting inflation to get to that 2% target, they're still revising much of their Fed forecast to reflect the earlier start to cuts in their baseline forecast, greater asymmetry of risks they're talking about to the downside here. So all of that considered, we'll see who ultimately is right with all these calls that we're seeing.
We will see, and only time's going to tell us who is right here over the next several months. All right, well, let's talk about the fact that investors are still looking ahead to key economic data out this week, including tomorrow's inflation report. We also have the Fed decision coming on Wednesday. Our next guest saying that the November rally left, quote, widespread overbought conditions in the S&P 500, but he is also warning that history suggests that short-term pain could be ahead for the markets before long-term gains. Let's break it all down with Adam Turnquist. He is LPL Financial's Chief Technical Strategist. Joining us now, it's great to see you here. So some short-term pain. You are, though it sounds a bit optimistic about the longer term. But what does this mean then for investors and their positioning going into the new year?
I think it really means there's potential here for a little bit of a pullback, as you mentioned, maybe some short-term pain before we see those long-term gains. The narrative in the market has really changed. You outlined how we're now talking about interest rate cuts instead of interest rate hikes. The market's gone from a correction to a comeback, had a huge November rally, very bullish. Just because we'll see some short-term pain does not mean that's a bearish call. But when you look at the underlying composition of the market, we had broad-based buying in November, a sizable almost 9% rally in the S&P 500. And what that did, it created very overbought conditions historically. So we had about a third of the S&P 500 actually reach overbought conditions based on a momentum indicator that we like to look at. Now, that's extremely rare when you go back to 1990. That's only occurred less than 1% of the time. And if you look at the forward returns during those prior periods, the market typically is, we'll call it flat over the next 1 to 3 months. However, going to the longer term, and I think that's where investors should be focused, 12 months later, the average return during those periods, just over 12%. Only one had a negative return as well. So we do think there's a pretty good positive read-through as we look ahead to 2024 based on that data.
Adam, when you hear calls on the street pulling forward some of their estimations for a cut in Fed policy, does that signal to you that we're perhaps more imminent to a mild or shallow or mild recession, depending upon which camp you're in at the end of the day? Because that would perhaps suggest that the Fed sees something so dire that it actually needs to cut.
That's really the key question, I think, because we've seen rates come lower. We've seen Fed rate cuts get pulled forward to March, right around 40%. And we have to ask ourselves, why are we seeing rates move lower and why are we pricing in interest rate cuts? Is it because recession is more imminent than expectations, or is it a victory lap on inflation? I think we'll get a pretty good read through from the Fed this week at their December meeting, and we'll get the updated summary of economic projections. I think right now, though, the market's giving the economy the benefit of the doubt of a soft landing scenario. we're kind of in this Goldilocks scenario, and for now that seems to be okay for the market and for this rally that we're seeing.
Adam, when we look ahead to next year, after we get past maybe some of this uncertainty, some of that leadership that we should be expecting, we started to see a little bit more of a broadening out in terms of market participation. Is that something that you see trending, I guess, to the upside? And in terms of that outperformance, who do you see in those leadership positions?
We think communication services is really firing on all cylinders. I like to look at the charts. Technically, we just had a breakout from a multi-month range on communication services. So we think there's upside there, potentially going back to retest the 2021 highs. And then on the fundamentals within communication services, just reported a great third quarter earnings. Calendar year 2024, you're looking at expectations for about 17% earnings growth for that sector. Revenues growing as well, margins growing. And this is not just a mega cap story within the sector. This is broad based. You're seeing over right around 2/3 of the sector above their 200-day moving average. A third of those stocks are beating the market this year. We think that momentum will continue into 2024.
Adam, where's the strongest technical strength in the market right now?
Right now, at a style level, we're seeing the growth sector, of course, those quality high cap or mega cap names leading the way. That was the story of the breakout that we witnessed above 4,400. However, we're starting to see areas like financials participate in this rally. They have not for most of this bull market. So we think that's a constructive sign for the health and sustainability of the bull market. Of course, communication services, they've been a consistent outperformer as well. Tech, which is home to many of those mega cap names, also outperforming. So that's some pretty big sector weights when you think about the S&P 500 as well.
Adam, we got a case last week of the markets hearing what they wanted to hear, or at least seeing what they wanted to see, and being very selective in the data that they were giving more weight to, and really thinking about the data that we got on the jobs front, and then also the data that we got on the consumer sentiment front as well here, where on the jobs front, we saw markets retract, but then once that consumer data came out, we saw markets move higher. And so ultimately, at the end of the day here, it seems like the markets are just going to see what they want to. Where are the strongest areas then to lean into as an investor, if that is the case, if there is going to be more of a, well, we'll just shrug off the data that we don't like to hear?
Yeah, I think there's some of the more beaten up areas. That's where investors have been looking a little bit. Think about valuations. I think they're looking at some of the cheaper areas of the market. Of course, financials were a big beneficiary. If you look at how they performed in November. So that's an area we're neutral on right now, but I think investors should be watching, not just for an opportunity, but just for the read-through when you think about the leadership that we're starting to see there and what that means for the market. We like energy as well. That's one that's been pretty beaten up. We think there's scope for a potential relief rally off oversold levels. The sector is trading cheap, generates a lot of free cash flow. Oil looks like it's getting close to a bottom here in terms of some support levels that we're watching and getting pretty washed out. So that'd be another area to focus on.
Really great insights and analysis. Adam Turnquist, who is the LPL Financial Chief Technical Strategist. Thanks so much, Adam. Appreciate it.
Thanks.
Absolutely. Well, Cigna is calling off its acquisition of Humana. The two health insurance companies couldn't agree on a price. That's according to several reports. Cigna now planning to spend about $10 billion in a stock buyback. For more on this, we've got Yahoo Finance reporter Anjali Kemlani here with us in studio. Hey, Anjali.
Hey, we got heartbreak for this deal.
Oh, no.
Well, maybe not so much. We definitely saw the street respond negatively to those reports last week that there could be talks. And while neither company did confirm or deny those talks, we do now know that they are, as we mentioned, falling apart. We did get some of the positives for Cigna with the stock buyback. JPM analyst Lisa Gill saying a note, with the deal in the rear view, we are positive on the near-term outlook for Cigna following strong Q3 results and believe a solid fundamental setup heading into 2024. And that seems to be sort of the riding sentiment for all the analysts who cover this. Humana definitely was looking and has been looking for several years, for a buyer. Over time, we saw deals fall through about a decade ago. The two had been talking then, so this was the second go around sort of for the two to partner up potentially. But one of the big factors had been then and still is now the FTC and the potential delay that would have caused the deal. So while yes, price and terms had been part of the breakup, definitely, the street analysts had all been looking at what that long-term drag could have been. So it seems like everyone's pretty excited about this.
Yeah, and on to that point, what were you hearing just about what the timeline could have looked like from the pressure they could have seen from regulators about whether or not this even would have been approved?
More than 12 months. 12 months or more, yeah. So it would have been, maybe even up to 2 years, if I remember correctly from those notes. And that means that something that could have started now would have, put a lot of pressure on the companies for some time. Cigna would have benefited from this because it could have really put it on par with CVS and United, giving it, assets that it doesn't have. It is looking to spin off its Medicare Advantage. So, there were pieces that worked. It did look good on paper, but ultimately looks like not a deal that's going to go through.
Not for now, at least. All right, Anjali Kamali, thanks so much for breaking that down for us. We want to get to another trending ticker of the day, and that is Occidental Petroleum. It's buying Crown Rock, the oil and gas company, which Warren Buffett owns more than a 25% stake in, is buying the energy producer in a cash and stock deal valued just around $12 billion. And it is expected to close in the first quarter of 2024. Crown Rock is a major gas exploration company that's developing a 100,000-acre position in the Permian Basin, and this comes after several energy consolidations in the region. One major deal being Exxon buying Pioneer. We also had the big deal from Chevron just not too long ago, several weeks ago. And Brad, I think this points to the fact that this is something analysts have been calling for quite some time. A number of these companies flush with cash coming out of the pandemic in a very strong position. They're looking to put that money to work. They're under a tremendous amount of pressure from investors in terms of their buybacks, returning capital to shareholders. They're looking for ways to expand, and they're seeing that the most opportunistic, or maybe the way that makes the most sense, at least for now, money-wise, is to go out and do M&A, and that's going to give them a little bit more exposure to some of those drilling sites and a way to grow their business.
Yeah, absolutely. Some of the highlights that the companies are calling out here, they're expecting on the financial front, delivering increased free cash flow, that FCF, on a diluted share basis, including $1 billion in the first year based on $70 per barrel WTI. So it would be reliant on it kind of averaging out at that level, and then complements some of the enhancements that you were talking about in Occidental's Permian portfolio. Addition of approximately here 170,000 barrels of oil equivalent per day, high margin, lower decline, unconventional production in 2024, as well as approximately 1,700 undeveloped locations. So significant acreage that they're adding on here, and then also increasing some of the break-even inventory, the sub-$40 break-even inventory, by about 33% here. So this is a growing of the locations and the acreage that they have. It's a growing out of even the dividend that they're going to be paying out as well here. The companies had mentioned this is supporting a quarterly dividend increase of about 22% to 22 cents a share here as well.
Something you think would make the shareholders happy, at least until this point. Also, we want to point out that this is the largest deal here for Occidental since that massive takeover of Anadarko just a few years ago. So if the street's right, we could expect maybe some more M&A activity within this space. We got to leave it there for now, but keep it right here on Yahoo Finance. We've got more of your market action ahead. We'll be right back. In a major step forward for patients and researchers, the FDA approved the first gene therapies to treat sickle cell disease. This includes the first gene editing treatment. But it's not all clear skies ahead. While this technology behind both treatments is groundbreaking, the logistics, also the sky-high price tags of both Casgevy and Lyfgenia will likely limit some access. We want to bring in David Nierengarten. He's Wedbush Securities Managing Director of Equity Research. It's great to see you here, David. Let's just first take a step back and talk to us just about the landmark decision, what this is and how significant it is in terms of making some treatment available and being able to treat some issues that we haven't been able or hasn't been possible in the past.
Yeah, it's a real technical achievement, a real victory, for these companies to get these products approved. The first, gene therapy and gene editing products here for sickle cell disease. It's been a long time coming. Bluebird, I think they treated their first patient back in 2013, 2014, somewhere around then. And so this has been a long time coming. There's definitely a bunch of stops and starts along the way, but a technical achievement for these companies and a victory for patients who really, it's with the severe form of this disease that really are suffering.
A technical achievement and no doubt scientific breakthrough and discoveries here. So now the companies swiftly move towards, okay, how do we get this into the market and how do we make sure that we're advancing some of what we've been able to develop around here? How does that change the company profile from your perspective?
Yeah, that's the real challenge now going forward. So you mentioned the price. I think there are going to be discounts here. That will not be the true net price that these companies realize. But really a bigger challenge for getting access to this technology is the process involved with this. The patients are essentially undergoing a bone marrow transplant. This requires them to spend several months preparing for the procedure and then several weeks, 4 to 6 weeks in the hospital. As you can imagine, that's very difficult for a lot of people to stomach. And that is the real challenge here is trying to market this technology in the face of this relatively challenging procedure. I do think it will be limited to the most severe of these patients, of sickle cell patients. But again, for those patients who are willing to do this, it can provide a lifelong cure.
When it comes to that lifelong cure, obviously there's clearly an incentive here for patients to want to try if it makes the most sense for them to have access to these types of drugs. When you try to guesstimate what the adoption is going to look like, when you take a more longer term view, 10 years from now, what does that look like, at least from where you stand today?
Honestly, it looks like low single-digit percentage. I do think that is a kind of a ceiling on the number of patients who are severe enough that they would undergo this procedure. But these are patients who are in truly bad shape. Patients, you can see 13, 14, 15-year-old patients with stroke, heart attack, never mind the excruciating pain that they go through when they do have the crises, going to the hospital and for multiple days to treat the pain and other effects from the disease. So for those patients, it's going to be truly transformative, but it is going to be a small percentage of patients, in my opinion.
David, Anjali here. I know I've heard similar, in part because of access issues in terms of location, in terms of the price point. When it comes to the fact that this is something new, is that low uptake surprising in any way?
I think it's, when you think about the procedure, it's not surprising. I think if this were a shorter procedure, if it only took a few days in the hospital, if there were other, ameliorating factors to the procedure, I think you would see a higher adoption rate. But yes, I think the real barrier here is the procedure itself, the time it takes to do it, and the difficulties involved with it. You mentioned access and sites. That is going to be another issue. You need essentially bone marrow transplant site, and many of the sites that the companies ran their clinical trials in, frankly, have relatively low populations of sickle cell patients, and they need to expand sites, in my opinion, to other areas of the country that have more patients locally.
It definitely looks like of the companies involved in this, we saw Bluebird really get hit negatively because of the label. We know that Vertex and CRISPR are still going to have long-term studies for this. So I just wonder, do you think that there's going to be any longer-term impact because of the concerns of side effects, because of the concerns of off-target gene editing, any of that?
Yeah, so that's part of the concerns. Besides the procedure, Bluebird, of course, had a black box warning indicating the risk of secondary cancers after the procedure is completed, and that is a real risk. And that's part. There's also an assumed real risk for increased cancers, although it's not in the label for the gene editing product as a black box. It's not in there, but those are longer term questions. Frankly. Again, in the most severe patients, lifespan is shortened to 30 to 40 years in many patients. So secondary cancers are probably less of a concern, but longer term, patients do have fertility issues. Usually, they become infertile after this treatment and such. And so, again, that's going to limit some of the patients who are willing to do this procedure.
David, just lastly, while we have you, I mean, if we were to compare this at all to some of the other scientific breakthroughs that we've seen, messenger RNA comes to mind for a lot of people as a platform. Is this type of gene editing the type of messenger RNA multiplier that we could potentially see for companies that are able to move forward some of the development around the products and solutions that they're bringing to market?
Yeah, so absolutely. So what's really important here from a regulatory and procedure viewpoint is that the FDA did approve these products. The FDA is now officially comfortable with gene therapies, gene editing technology, in my opinion, and this will help catalyze the development of new treatments, treatments that don't require essentially a transplant to deliver the gene therapy or the gene editing, and I think that is going to provide a tailwind for many of these stocks in the near medium term for the development of their products.
All right, David Nierengarten, who is the Wedbush Securities Managing Director of Equity Research, and Yahoo Finance's own Anjali Kamlani. Thank you both.
Thank you.
We're also tracking JP Morgan here today. They're warning of rocky circumstances for the U.S. stocks next year. Strategist Marko Kolanovic cautioned clients of a catch-22 situation, saying a rally in equities is unsustainable without significant rate cuts from the Fed, which he doesn't expect without a severe drop in markets here. And so this in kind of the range of strategies that we've seen and heard emerge going into 2024, and much of that really just positioned around what the Fed may or may not do at this point.
Yeah, I think this all hinges on what exactly the Fed is going to do. Nothing really new here from Kolanovic. We know he has tended to be a little bit bearish in terms of his expectations, limited upside that he's seeing for equities next year. And in a couple of the scenarios that he did lay out, two stuck out to me. The most optimistic economic scenario, he only sees equities outperforming bonds and cash by only about 5%. Now, in his expected environment of declining growth or a recession, he's saying that this group could actually underperform cash by around 20%. So clearly he sees a lot more downside risk ahead for the markets. A lot of these projections hinging around what the Fed rate cut timeline looks like, exactly when we could potentially see a rate cut. The market very optimistic, maybe a little bit too aggressive in pricing in the fact that they see one as early as almost the first quarter of March of next year. So when you take that into account and compare that to some of the more reserved expectations, there certainly is a wide variety of when that timeline is going to be. And also not only that, but once the Fed does start cutting, how quickly then they will continue to cut is also obviously up for debate.
Yeah, and if you're taking some of the riskier assets off the table, does that then lean into the growth as a reversion type strategy? And that's something that we've heard, at least as we've been asking some of the strategists for their end of year and going into 2024 resolutions for trading. I've been hot to trot on that.
You have been very hot to trot. Well, there's a lot more to go here because we are only an hour into the show, and an hour is a long time in news. So imagine how much a year is. Now, it'd be almost impossible to compile a list of the top stories of 2023, but somehow we did it. Inflation was still an issue. The ruins of the FTX fallout continue to crumble. A plastic doll from 1959 metamorphs into one of the biggest box office smashes of all time. And we also have Taylor Swift singing all the while.
Yes, she did. Was she number one, though? Did she make the list at all? What about the regional banking crisis? Feels like it was 100 years ago, but it was in March. Tune in to Yahoo Finance's Top 10 Countdown with the stories that you loved and the ones you just couldn't get away from. That's all from today. You're watching Yahoo Finance.
How do we reimagine and future-proof our retirement without relying on Social Security?
Let's underscore why Social Security is as important as it is.
Somehow we need to reverse the bragging rights, right? The bragging rights today is I own a nice car versus I have a large 401k account.
Never, ever, ever will Social Security be eliminated. Politically and economically, the case is very, very strong.
The clock is ticking. If you plan on relying on Social Security to pay your bills in retirement, think again. In 2022, 58 million people were eligible for Social Security. That number expected to jump to 75 million by 2035, with the reserves expected to run out by 2033. So how do we reimagine and future-proof our retirement without relying on Social Security? So, Bob, I want to start with you because for almost 90 years, Americans have been able to rely on Social Security as at least part of their retirement. But once the reserves do run out, will future generations be able to rely on Social Security? Will it have the same impact?
Well, it's a hard question to answer because we don't know yet whether Congress will act to rescue Social Security. If it doesn't act by 2033, Social Security will only be able to pay out 8% of scheduled benefits. Right now, if we look at Social Security, it represents 85% of retirement income for those in the lowest income quintile and about 15% for those in the highest income quintile, and maybe on average about 40%. If there is any rescue to come, it may not affect those who are the oldest or the poorest. It's more likely, as what happened with the Greenspan Commission, to affect those who are 40 and younger in terms of either increased taxes or lower benefits or a combination thereof.
So as we try and imagine what a future looks like without Social Security, do you think there ever will be, Teresa, a time when Social Security will be eliminated? And where do you see this headed?
Never, ever, ever will Social Security be eliminated. The politics for Social Security are just way too strong. Democrats want the benefits not to be cut. Republicans want the benefits not to be cut. So the political reality is that Social Security will be there, and the economic case for Social Security has never been stronger. Social Security is supposed to complement a voluntary savings, or a pension system, and on top of that, home ownership. And so it was always supposed to be around 40% of middle-class retirees' income. For lower-income people, they rely almost all on Social Security, and for the top, and it might be relevant, that's like PIN money. But for the middle class, it was only supposed to supplement. But in the past 20 years, that private sector, no offense, system has not filled in what Social Security has provided. So over the past 20 years, Social Security has gotten more important for retirees. So politically and economically, the case is very, very strong for Social Security.
Sorry, I want to bring you in here because when you factor in then also inflation and job security into the retirement savings picture, how does this complicate things?
Yeah, this is I really appreciated Bob and Teresa's points here, but let's underscore why Social Security is as important as it is. There's market risk, of course, and as you mentioned, inflation risk. But let me add two others. There's longevity risk people are taking on, and inside that, what I might call cognitive risk. So I serve on the New England chapter of the Alzheimer's Association, and I've learned there that when you get to age 85, the chances of getting deep dementia or Alzheimer's disease is 1 in 3. So we're living longer, so we need income that's going to support us to address all these risks. And when we look at data at the Institute on what kind of income are people getting from Social Security, Black African Americans, Hispanic Latinos are ever reliant on this, but guess what? Their income is lower compared to other demographic groups. So this is a very vital question you're bringing up.
And so then when you think about who's going to be most impacted, you mentioned obviously minorities and those at lower income are going to be most affected. But Surya, when you look at millennials and zennials, who are also going to be the most impacted there, what should they be doing now then to bolster their savings on the chance that they won't be able to rely on Social Security?
Yeah, so let me give you, based on my experience with young adults coming in as summer interns into our company or joining as new analysts, of course, if you talk to them about save more money or get your employer match and all these money terms, it could be a turnoff. It could be like a eat your spinach message. Whereas I've tried it to frame it in terms of, hey, you might be expected to have 100-year lives, and compared to your grandparents' generation, you've been accorded a longevity bonus of 17 years, 20 years, 25 years. How are you going to spend it? That gets their attention. Now finances become a means to facilitate that 100-year life.
That's a really good point. What you have to do is imagine their future self, have them empathize with their future self, have them imagine trips they will take with their future selves, and then they have a motive to save, because the motive is really to spend.
Correct.
We all are humans that are motivated to actually consume and have fun.
And somehow we need to reverse the bragging rights, right? The bragging rights today is I own a nice car versus I have a large 401k account.
And I think this generation is much more likely to brandish their accounts, because this generation is much more financially aware than any other previous generation. They've had to grow up fast because we saddled them with student debt.
It's also more complicated, I think, Teresa, right, in the sense that we didn't have an HSA when we entered the workforce. We didn't have a Roth 401k. And now the need for them to become not only knowledgeable, but experts in how best to save for that longevity bonus.
Well, we've turned financial planning into a do-it-yourself affair, as if we now told younger generations, now you have to do your own dentistry. You know, it's like, God, the system is not really built to be this complicated for people. And most nations don't do it the way we do it.
A big thanks to our very own Rochelle Akufo for bringing us that interview, and some really great arguments made from our panelists there. And naturally, I think about some of the biggest companies that are set to be impacted if we were to see a significant shift in the either amount people are saving for retirement or how they're saving for retirement, the vehicles that they're using, or even the assets that they're investing into as well here, and kind of using as their golden egg that they can just kind of put off to the side and continue building around here. But most notably, the banks immediately come to mind, and those that have the largest retirement or wealth management under their assets under management and their planning as well. And I think that's one area where if there are investors out there that are trying to figure out how they could potentially play this broader retirement space, the banks come to mind. You've got Charles Schwab and some of the larger trading firms as well that also come to mind here too.
Yeah, you also have Fidelity, Vanguard, and the list goes on just in terms of where so many of these investors potentially are allocating some of their future returns here when it comes to saving for retirement. And I think the resounding takeaway from all this is, one, it's never too early to start planning. Two, you can never bank on something else happening that's outside of your control. For this instance, is Social Security. Exactly what that's going to look like decades from now. The estimates are all over the map for how quickly it could potentially run out, what exactly needs to happen in terms of Social Security reform. A lot of that also hinges on who is in the White House and who's dominating some of these parties here within Congress. So I think when there are so many unknowns out there, it is very important to take control of your own financial destiny. A lot of that has to do with the fact that you need to start saving early. You need to start allocating some of your income to 401ks if you do have that as an alternative. And you need to capitalize on the fact that many of your companies are matching up to a certain percentage point. So if you're doing all of that early, you're preparing for what could be decades away, then you would be at least in a better shape than you would have been if you didn't start planning till your 40s, 50s, or God forbid your 60s.
I'm trying to retire by 40.
That would be nice.
It would be great.
That's
it would
not
be
too much
great.
time left for
There's
you.
a lot of would be, could be, should be's, but
Never know.
Will it be?
You got to be very, very smart. Make a heck of a lot of money if you want it to last all the way through if you're tired of 40. All right, keep it right here on Yahoo Finance. We've got all your market action ahead. We'll be right back.
Novo Nordisk became Europe's most valuable company this year thanks to the seemingly overnight popularity of its drugs Ozempic and Wegovy. So it's no surprise that we named the Danish pharmaceutical giant as our company of the year for 2023. Yahoo Finance health reporter Anjali Khemlani was able to sit down with Novo Nordisk's CEO to discuss being named company of the year, the company's recent successes, and much, much more. Let's take a listen.
It's obviously a great honor to get that prestigious prize, and in many ways, it's a good picture of a fantastic year for Novo Nordisk, and actually a number of years where we've seen a very dramatic growth, and all based on some really interesting and fascinating innovation we've been doing for many, many years. So we're really pleased to be in this wonderful spot.
Absolutely. And this is, of course, because of Ozempic, Wegovy, the GLP-1 products that have had astounding weight loss results for people. It's funny to me because, you know, Ozempic was approved in 2017, Wegovy in 2021. Are you surprised by the fact that a couple years after or several years after this approval, you're suddenly seeing this delayed success?
It's a great question because we have been researching in this for many decades. We have done obesity research for more than 25 years. We have all along felt that it was a really meaningful focus area for us to have, being a leader in diabetes care and knowing that many of those who develop type 2 diabetes, they develop it because of overweight. So why treat the disease if you can actually prevent it by addressing the underlying causes? But we also know that for many years, anti-obesity medicine was not widely used. And they were not all delivering up against patients' and physicians' expectations. So we saw with our latest innovation that we really, perhaps for the first time, met those expectations. And a lot of discussion was ongoing about, okay, now there's finally an efficacious treatment for people living with obesity. And then suddenly the whole market takes off, and that's really fascinating. But also comes with a lot of hard work because we have to scale up and ramp up manufacturing like we have never done before. But it's all really exciting, and I feel so proud on behalf of all the great colleagues and really committed employees in Novo Nordisk, and it's really a credit. Getting this prize is really a credit to all of those who go to work each and every day focused on helping patients.
Yeah, I'm so glad you brought up the manufacturing. You're investing a lot in that, about $4 billion for the upcoming years to expand manufacturing almost directly as a result of this. But do you feel like you may be over-investing considering that there are, competitors coming down the pike? There's so many others that are going to be in this space soon. Do you feel like you're on the right track with this?
I believe we are ramping up as needed, and if you think about it, WHO predicts that by 2030 there'll be a billion people living with obesity, and so far we're just scratching in the surface what that means in terms of bringing them efficacious medicines. In the U.S., there's more than 100 million with a BMI above 30, so there's room for competition, there's room for choice. As long as products stay safe and they get, say, well above 15% in weight loss, I think you can have a serious play. And we have a very strong pipeline coming. We are already now in late stage development of our next generation product. We know what will be moving into the pipeline in the coming years in terms of even stronger products. So for us, this is a long-term journey of getting to more and more patients. And I think we have maybe one of the best opportunities in driving population health intervention and really preventing some of the comorbidities that follows living with obesity. And I think that's a great value add for the individual patient. It's great for society, for the healthcare systems that are struggling in most countries, aging populations, and a number of burdens on governments driving green transition, handling aging population, and also now spending increasingly on defense, etc. So really investing in medicines that can drive prevention and improve health outcomes is living the purpose of a company like Novo Nordisk, and we're really proud about what contribution we can have in that space.
Yeah, it's such an interesting story because, you were known for insulin for so long, and now this expansion, you're giving Wall Street the diversity it has craved for the company's portfolio for so long. But you've also found yourself sort of in the common culture, with the mass population that recognition of the brand, probably not what you want with everyone just calling everything Ozempic, but at least they are recognizing the brand name. So I wonder how that's been for you, knowing that this became sort of celebrity culture and, it's been everywhere this year.
Yeah, it's a big change. I've been with the company for more than 30 years. I'm only the 5th CEO in a 100-year-old company. And now we're growing, around 30%, 100 years into our lifetime. And suddenly we have brands that are becoming household names. And we've never, ever had products that were widely known. So I think it causes some challenges how to handle that, but also drives a lot of opportunity. And if you think about, as I mentioned before, over some time, hundreds of millions of patients living with obesity. And for us to get to them, if we had to have a huge sales force to go to each and every person, we would never be able to get to many of them. But with brands being established, there's a different opportunity of actually reaching more patients. And again, when we can drive health resilience, stronger health outcomes by doing that, it's actually really, really nice to have brands that leads patients to seek care, because we can drive even bigger change than what we could have done if these were not well-established brands. So it caused a lot of change for us. We have to face different challenges, but I see it really as a big opportunity for helping society and get to many more patients than we've ever done so far in the history of the company.
Yeah, it's really interesting because you're sort of like a fashion house now. You have to deal with knockoffs, especially while you still have the shortage ongoing. So that must be an interesting position. But I want to talk about the company itself. It's got an interesting corporate structure. We know that you were recently compared to even what's going on with OpenAI and having a very different corporate structure. How does that get affected with this success? Who wins at the end of the day? And how do you personally feel about, how this success is impacting the company?
I would say that what we do inside the company has not changed at all. So I mentioned that we've been researching in obesity for 25 years. That continues. We've been producing medicines for people living with diabetes and a few other diseases for 100 years. So the activities inside the company continues. We have an ownership structure that's interesting in the sense that we're controlled by a foundation. So the founders of Novo Nordisk actually gave control of the company to a foundation because they felt that would be the best long-term ownership for the company. And then, of course, we are listed on the stock market. So we have the discipline that comes from being a listed company and assessing, the market is assessing our performance on a daily basis. But then we also have this stable anchor in the foundation, which has a controlling stake, and they have a really a forever mindset in what we do. And that's a bit how we look at our business, that we're in this forever. So we're not chasing short-term returns, but we're really trying to build value for the long term with an eye for the social responsibility we have, the environmental responsibility we have, and of course staying a healthy company from a financial point of view. So these triple bottom lines we pursue is kind of guiding everything we do. And I think that creates a very good long-term perspective and a balance of succeeding as a company, but also adding value to the society we serve.
We have Anjali Kamlani here back with us on set. And Anja, it was a very wide-ranging interview that you just had with Lars, just in terms of the potential for this drug, what the pipeline looks like beyond Ozempic, and also just in terms of what the future is going to hold with R&D and so much of that priority and where that exactly lies.
Yeah, what's really interesting to me in that conversation, though, is how much he seemed to care about the societal aspect of it. And I think one of the conversations that's being had as a result of this runaway success of this drugs is how much food needs to change. Not just that it's going to impact people's cravings, but also what the food industry, which has long been overdue for some change and an overhaul, hasn't, there's just been no pressure on them. Does this act as sort of that final lever to push them into healthy eating and healthy foods being produced for us and finding ways to make that economical? I think that's part of the conversation that is the future of this whole sector. And so that's the fascinating part to me is, how he thinks about how this drug impacts the way we have, more sedentary society and the like. But definitely, future outlook. We talked about this a little bit ago, just there's so much competition in the space now. They have to ramp up manufacturing. They're dealing with as one of the analysts said earlier, a huge company like Eli Lilly who started the GLP-1 sort of, race, but this is just such a new segment of this story. So it's really interesting, just all parts put together.
Do you get a sense that they believe that this leads to a healthier society at the end of the day?
The goal is that in some people's eyes. I think the company sees itself as sort of stemming that tide, helping where food is not, because they are not a food company. Sure. So where they can have any impact, that I think is where they're looking.
Because it's a total change in lifestyle.
Completely.
At the end of the day, too. And that's what's still being studied. I mean, you talk about food, it's going to change, according to some studies, the sizes that people are wearing by 2 to 3 sizes as well. So there's wide-ranging impacts here as well.
And the undertone is if everyone stays on it and doesn't regain the weight. And, we find out that it's okay to take very, very long term. So many unknowns. It's certainly a new chapter. And it's so interesting to just sort of be in the front row watching it.
Yeah, absolutely. Well,
the frenzy has been amazing to watch, just in terms of the astronomical rise, just and the popularity of these drugs. Miles pointed it out in a package that we played earlier. It almost has just become a verb, right?
Yes.
When you talk about the back, when you say they're on Ozempic, most people know exactly what people are saying or referring to. So how they're able to capitalize on
Ozempicing?
Ozempic, but you don't know that they didn't. Yeah, well, it's kind of like, I guess not so much a verb, but it's kind of like how you would say, did you grab the Uber? Are you Ubering there?
True.
Are you Ozempic? And that's not really going to work out. But you know what I mean. You're pointing to you can use the word that they coined Ozempic for their drug, and it really points to
it's got its own
broader.
street cred.
In my Wegoving on Saturday with my self-care that I do
you'll be
well.
Wegoving a couple of days in a row here,
I guess
but
so,
yeah.
All right, Anjali,
in order for it to work.
Thanks so much. We're going to workshop the verbification of this.
Let me know.
We'll do. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. It's a busy week for economic data before the holiday season kicks into gear. CPI and a Fed rate decision, they are on the agenda this week. Markets are betting on a soft landing next year. So will the numbers reflect that narrative? For more on this, we've got Yahoo Finance reporter Josh Schaefer here to tell us more. Hey, Josh.
Yeah, Brad, so we just had the calendar up there, and I want to just take a closer look at that and point out some of the key data points that we have coming this week. So, of course, we have that CPI print tomorrow on Tuesday. That's a reading on inflation. It will be our first reading of inflation for the month of November. PPI on Wednesday, producer prices, what are companies paying, right? And then Fed decision, obviously, on Wednesday is the real highlight. Thursday, you're going to get a look at the consumer with retail sales. But I want to zoom in today, Brad, on inflation a little bit, because that is one of the bigger prints we're going to get this week, and it's the first one that we're going to get on Tuesday. Goldman Sachs had an interesting chart out today. Or actually, I'll hit you with the projections first while we're showing them on the screen. Why not, right? Month over month, looking for flat, year over year, 3.1%. Then when you take a look at core CPI, economists are expecting a 4% rise in core CPI, also month over month flat, though, which is key. That has been coming in. Inflation has been falling quicker than people expect, which is the chart that I want to get to here. When you take a look at this chart from Goldman Sachs, it's PCE, which is a different measure of inflation, but it tells the point of what we're trying to show here. You can see Goldman's current forecast in light blue there. Yellow was their former forecast for inflation. So inflation forecasts have been dropping as inflation has been falling quicker than people thought. The key reason I bring that up, Brad, is because when you look at that orange line there coming across horizontally, right, that's when they think the Fed is going to cut. You can see how much quicker we reach that orange line with the current forecast for inflation. Came up about 4 months in Goldman's forecast today. So inflation coming down quicker than people think is part of what's driving this narrative that we might get a Fed cut quicker. And so that will be something we're watching for tomorrow.
Yeah, if the graphic didn't come up, I was just going to hold up my paper.
Yeah, we could zoom in. You know what I mean?
You're always ready.
I printed it off.
Notes.
You know I printed it off.
Yeah, exactly. The one note that you decided to print today, he does. So you can always count on him. All right, Josh, thanks so much for breaking that down. Certainly a busy week ahead. Well, new analysis from the Washington Post found that at least 8 fatal or serious crashes involving Tesla's autopilot occurred where the autopilot feature should not have been accessible in the first place. Now, the car's manual does warn that its autopilot can be unreliable on roads with hills and curves, but the company has not taken steps to limit its availability by geography. Now, for more on this, we want to bring in Colin Rush. He's Oppenheimer's managing director and senior research analyst. Colin, it's good to see you. Let's talk about what this means just in terms of wider spread adoption, right? Because we've seen the fact that EVs, at least in terms of demand, that demand seems to be falling. We have this report out from the Washington Post pointing to some issues that Tesla might have here with its autopilot system. What do you think how big of a risk do you see this being for Tesla, at least in the short term?
I want to step back a little bit on this EV narrative, because I think the growth has been moderating a little bit. We're still talking about 35 to 40% year-over-year unit growth on EVs. So I just want to make sure that point gets made here before we move on to the autonomous question. But the report from the Washington Post is important because it raises the debate that I think is happening within the industry about how to manage risk as you bring this new technology into the market and who's actually responsible for that risk. And the Tesla policy that we're seeing really puts the onus on operators to comply with the manual rather than putting some incremental controls on this. And underlying that is a belief from Tesla that the system is actually better than drivers. And so statistically, it's more, it's likely that these cars will perform better than a lot of drivers on the road. Whether that's real or perceived, by regulators and the general public is still to be determined. But I think the regulatory approach that we've seen so far is that the regulators are following the industry because the technology is moving so quickly. And as we go forward here, I think there's going to be more public concern and transparency that's necessary to really gain trust amongst the broader population around how these vehicles really do carry forward.
So, Colin, but you don't see that weighing on demand, at least for Tesla, in the near term until we get some more clarity on that?
Yeah, absolutely. Tesla's got a brand issue, and this really started with Elon's acquisition of Twitter and his public persona and what he's got in that public discourse around his political views and whatnot. And so, as we move forward with this technology, I think it's a part of a larger branding issue for Tesla in terms of how they present themselves, because they were seen really as the leading company on bringing clean, safe vehicles to market. And now, as the reality comes forward, there's a lot more going on here, and I think there's a lot of folks that have gotten concerned with supporting Elon Musk individually from a brand perspective, and there is this ongoing cost out program and kind of war of attrition that's happening in the EV space as well. And so I think this is just one more element of that broader dynamic, and it certainly isn't going to help folks buy the FSD offering or sign up for it up front. And there's going to be a lot of concern from other folks on how other OEMs are carrying this forward as well.
How does Tesla need to rebrand itself from your perspective, Colin?
I'm not convinced they need to rebrand themselves, but I think they need to show a little bit more corporate responsibility in the public markets with folks, pushing this off onto consumers that are then ultimately responsible for how the technology is engaged. I don't think is fulsome enough in the view of a lot of consumers and a lot of consumer advocates. And so as I think this company figures out how to really position itself in the marketplace, it needs to balance the innovation that it brings, which is a real asset, but also doing that in a responsible way. And where those lines are drawn, I think is going to be really important for the company as they try to bring FSD like fully into the market and introduce it as a real offering that they can monetize.
Colin, I want to pivot here just a bit and talk about another big headline when it comes to Tesla, what we have seen really play out over the last several weeks, and that's the UAW. Now we have the UAW targeting more automakers. Tesla seems to be one of their targets. It's going to be a pretty highly contested battle, I would think, between Musk and the UAW. How do you see that shaping up next year?
Yeah, it's really such an important question. First, it's important for workers to have a living wage, and that's critical for our economy and for just general decency. How that carries forward into the actual manufacturing process, I think it's going to be a big fight, and this is a very public fight. What we saw with the big three is that the labor movement and organizers actually did quite a good job of getting what they wanted for their constituents. And how this plays out with Tesla, I think, is going to be very high profile, not just for Tesla, but also for the Magnificent Seven in the tech industry, and particularly as it pertains to other folks like Amazon, who has resisted unionization in a number of their facilities. I don't know how this ultimately goes and how the negotiations play out, but the collective bargaining, I think, is something that's going to be an ongoing issue, particularly as we've seen some of these companies really grow much faster than others, and the country really works towards having a sustainable manufacturing base here. And I think this is going to be one that is going to have a lot of twists and turns. It's going to be very interesting to see how it plays out.
Yeah, there's several considerations on that front. If they were to have to kind of go head-to-head with the UAW, could impact the margins at the end of the day, which would have already been in focus for investors for several years at this point, even amid a pricing strategy that they've rolled out more so internationally, where they've started to cut vastly to try and get people into the ecosystem for Tesla and then hope to see a larger customer lifetime value over time. All of that considered, what can we extrapolate from the deals that the UAW has already been able to make with the big three automakers here in the U.S. and perhaps apply towards Tesla and try to get the best case calculus for what that might mean for valuation and whether or not that's factored into the share price right now?
I don't think it's factored into the share price right now. Let's just be clear on that. In terms of overall impact, the workers in Tesla's factories are not unionized at this point, so there's a big hurdle that has to be cleared before you can actually get into a collective negotiation. And I think that's the first element that we're going to watch. As we look at the big three and the history with unions, that was very well established. There was lines of communication, a lot of history there. That's not in place in Tesla. And so the first thing that we're going to be watching for is whether those workers actually ultimately unionize or not, and how Tesla proactively really goes after avoiding that sort of unionization, and how they work through that compensation with their employees, and how it might evolve is a little unclear. We've seen a lot of folks end up with stock-based comp as part of their compensation, and how that ultimately gets shared across the organization is a little unclear right now as we move into the next couple of years. But that's one area that we really need to see get clarified. In terms of the overall impact on the margins, I ultimately think it's going to be on the level of, maybe a point or two on the gross margin level. And Tesla's really committed to driving cost out from a technology perspective. And so the labor content of these vehicles, I think, continues to move lower as we move forward, and that, incremental, cost to the company in the U.S. is going to be relatively small, from an overall perspective, but it could have that 100 to 200 basis point impact potentially.
All right, all things for investors to watch of TSLA going into the next year here. Thanks so much for joining us, Colin. Appreciate it. Oppenheimer, Managing Director and Senior Research Analyst. Appreciate it. Thanks. All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Yahoo Finance is counting down to the biggest story of 2023, but what's going to take the top spot?
Whoa, Josh. Inflation is clearly the top story of 2023. Now, this pizza I have right here is supposed to be $18, but we're in New York City and I added pepperoni, so it costs, get this, $29.
All right, your pizza's more expensive, big deal. You might want to get that pie to go, though, because we all know the big story was OpenAI, ChatGPT, case closed.
AI was a big buzzword, Dan, but I think we're forgetting about a big event here. Remember that regional banking crisis back in March? Remember we had JP Morgan step in and buy First Republic? Pretty big deal, Brooke. Pretty big deal.
I'm kind of a big deal.
I think the banking crisis might win here.
All right, Josh, Brooke, Dan, I'm shoving you to the side because I think we're all forgetting about a small little cultural phenomenon known as Barbie. I mean, this is all anyone could talk about. 4 months, we're still talking about it.
Very true. But guys, I think we're all right here. Stay tuned for Yahoo Finance, and we'll hear what the biggest story certainly is as we count down to 2024. Inflation.
A fight for control of the skies and last or fast mile delivery. Alphabet's Wing venture is among one of a few freight delivery drones looking to elevate its retail customer experience and compete with e-commerce giants like Amazon. Now, with the holiday season in full swing, Wing sees appetite for fast mile delivery growing now more than ever. Joining me now, we want to bring in Shannon Nash, Wing's Chief Financial Officer, along with our very own Diane King Hall. It's great to see both of you. Shannon, let me start with a recent report that you just published. You looked into the fact, I guess, how people are shopping ahead of the holiday season, what this need would potentially look like for what you're calling fast mile delivery. What did you find?
You know, we found that 74% of the folks that we surveyed really saw a need for this instant fast mile delivery. And we're talking about things like it's the holiday party, everything is ready, you're about to set the table, and somebody, we won't name who, forgot the dinner rolls. And it's going to take, you know, at least 30 minutes to an hour to make that happen. We're seeing a lot of customers saying that for this fast mile delivery, they're looking at things like groceries. In fact, 43% said that they would use this service for last minute groceries. And then another 23% said they would use it for those gifts. You can't go to the party with an empty hand. So, you know, gifts are also something very popular among customers.
Shannon, first I want to congratulate you. I saw the note today with the CFO of the Year by Data Rails in the tech category, so congratulations are in order. Next, I want to ask you about the expansion strategy for Wing. Obviously, there are not a lot of players in the drone delivery space. So what is your market expansion strategy, especially when you compete against the likes of an Amazon?
Well, Diane, you know, we've done over 350,000 deliveries. We've operated in 3 continents, in Australia, in Europe, we were in Finland, and now we're in Ireland. And then in the United States, we started in Virginia, and now we are in the Dallas-Fort Worth area with Walmart. And so, you know, our expansion plans are to keep doing expansions, particularly in the U.S. We're focused on expanding with partnerships like with Walmart. In Australia, we've operated with DoorDash, so continuing to expand with those partners.
And I want to ask you about just the challenges that drone delivery faces. I know there can be some challenges when you think about, say, urban or rural areas. How are you all surmounting those challenges or addressing those challenges?
Yeah, we started, as I mentioned, in an urban area in the United States in a place called Christiansburg, Virginia, which is very close to Virginia Tech. And I'm a UVA grad, so you know, we're rivals, but I'm very happy that that's where we started our business. And what we found, Diane, is, you know, we have actually a couple that won the world record for the most drone deliveries in a rural area, if you will. They've done over 1,000 deliveries. And the number one thing that they ordered a lot of food. But the thing that surprised me the most is they ordered almost 100 boxes of Girl Scout cookies. So there's a lot of uses in the urban area. Then, of course, as I mentioned before, we've expanded, particularly in Australia with DoorDash, and that's in more urban environments, and we are in the Dallas-Fort Worth area in Frisco, Texas with Walmart in a more urban area. And we've been able to show that our drones are able to meet both environments.
Shannon, Wing is one of the exciting other bets that Alphabet has made here. And a lot of people don't get the insight into what the financials look like at the company. What does that pathway to profitability for this business unit look like?
I think that just in the drone delivery industry, I'll talk about it in a broad way. You know, the pathway to profitability really looks like scaling your organization, you know, across different geographical locations, and it also at the same time getting your cost right in line. You know, our plane only weighs 11 pounds. It's mostly made of styrofoam, so it's really getting the cost structure of your drone, you know, to be right sized for the scale that you're building. And at the same time, making sure that you're very focused on safety and sustainability in doing so.
And then Shannon, when you think about, obviously AI has been the buzzword of the year. When you think about efficiencies that are being created due to AI, how much of that is built in the expansion plans for Wing and how you all operate?
Yeah, AI is the buzz everywhere. You know, our planes are autonomous. I think that a lot of people, when I first meet them and I talk about what we're doing, they think there's somebody standing around with the joystick and driving the plane to drop off the packages. That is not the case. The planes plan out their own routes, and they're completely operated in an autonomous way. So you're going to see AI as a very important part of operating services like drone delivery, robotic delivery, et cetera, even more so than you see today, I believe. And then also you're going to see like AI is also being used to fuel innovation in all the back office functions, takes, the accounting, finance, legal functions. You're going to see more, I think, AI tools helping companies scale.
What are the final hangups that you're seeing with regard to regulatory red tape being cut in certain regions as you're trying to make even more of these deliveries and one day hit critical mass so that I can be in Brooklyn getting a delivery and we don't have to worry about the airspace?
Yeah, I mean, look, I think that we've made a significant progress from a regulatory standpoint. But look, there's still a lot that we need to do, that we need to unlock. I think one of the things that the industry is focusing on is really unlocking what we would say from a regulatory standpoint, the airspace, the number of what they call visual observers that have to be in the airspace for us to operate. And I think as these companies scale, you will see a more right sizing of how many people are needed to do that and how that impacts us opening the airwaves. So I'm with you. I can't wait for that day that you're in Brooklyn and get that latte delivered to you very easily.
I'll catch it.
Well, it might be a fight for that latte. And Shannon, before we let you go, we just want to get some predictions. We've been doing a lot of 2024 kind of thoughts and expectations. What are yours from the CFO office, especially for the C-suite?
I think I alluded to one of them, and you did as well. I think, look, AI is going to be, a big part of what the C-suite, in particular CFOs, focus on in 2024, and not just AI and how it unlocks, your operations, but AI in your product, in your service mix. I think that is going to be even more increasingly important because AI is getting better. And then the other thing, and particularly in our industry, I think sustainability will be even more important. Boards are looking at sustainability, different sustainability metrics are being, adopted industry-wide. And so I think you're going to see more conformity in terms of like how sustainability helps impact how industries are run and managed, but also how that value add hits the bottom line from a sustainability standpoint.
Shannon Nash, Wing Chief Financial Officer, and our very own Diane King Hall. Exciting to have this conversation with you. Appreciate it. Thank you. Well, some leadership shakeups at Shake Shack today. The food chain announcing its CEO, Randy Garutti, is stepping down after more than 2 decades at the company. Garutti going to retire next year. Until then, he will stay in his role to help choose a successor. After he retires, the company plans to keep him on as an advisor until the end of 2024 to transition the new CEO. So a shakeup in the Shake Shack land and ultimately in Burgerland. In a message, he did say, I never quite knew when this day would come, but in his heart, arriving at the realization for him, the family, the company, this is the right time. And ultimately, 24 years ago, Danny Meyer hired him and said, I'm not sure you're ready for this, but I'm going to give you a shot to lead Tabla. That was the Indian restaurant fronting Madison Square Garden in Manhattan. And then over time, Danny continuing to give him a shot. So really just showing how some of the other leaders in the industry pouring into him and then getting him into the mindsets to run a Shake Shack.
Yeah, Danny Meyer has certainly been a real mentor, I think, to Garutti here over the years. You mentioned the fact that he was a general manager of Tabla and Union Square Cafe. He was actually the youngest ever general manager there. So it really speaks to the confidence that Danny Meyer had in him, or has had in him now for years, and how quickly he has been able to scale Shake Shack's business. So it's interesting when you take a look at the share price reaction to this news. There is some optimism on the street just in terms of what exactly the successor could be or what it could mean here for the business. I was taking a look at some of the analyst reaction to this news, and Cowen was out saying that there is an opportunity here to hire an executive that does have a proven track record in scaling growth. And a lot of times when we talk about Shake Shack, it's exactly what needs to be done in order to further scale that growth and capitalize on some of the success that the company has seen over the last several years. So the fact that now they could have the opportunity to do this with someone from the outside coming in, having a clean slate, taking a fresh look at Shake Shack's fundamentals, seeing exactly where they can exceed, where maybe it makes sense for more of a strategic shift away from their current offerings right now. So the fact that they can start almost from, not from scratch, but from a brand new perspective here and really have the ability to launch Shake Shack into the next phase, I guess, of its growth. could be, and it seems to be something that the street is at least encouraged about for now.
I'll round this off with three thoughts that I think, and three major items that whoever the next CEO is going to have to think about. It's appetite, it's price, and it's technology. You've got more people who are looking across what the delivery mechanisms are and the technology that's infused into that experience. You've got the appetite with some of the weight loss drugs that we've been talking about that could shift, and you've got the price that consumers, especially going into a potential recession, are going to try and figure out, okay, do I want to pay $18 for a burger, fries, and a really good root beer float at the end of the day?
I was going to say that, and I'll also tack on one more, drive-thrus.
Yes.
Why don't they have more?
Yeah,
They
why
should.
not? Why
Easy
not?
capitalize on that. You don't even have to get out of your car. A lot of times people go there because it's convenient, quick in and out. Even better.
Just throw it at me, I'll catch it. All right, all your markets action ahead. Stay tuned, you're watching Yahoo Finance. Baseball fans witnessed an historic deal over the weekend. Shohei Ohtani, the superstar hitter and pitcher, has officially signed a record-breaking $700 million 10-year deal with the Los Angeles Dodgers. The deal is not only making baseball history, but also tops Patrick Mahomes' $450 million deal in the NFL, making it the largest North American professional sports here. Now, there's a few things that come to mind. Number one, this is not just a superstar in baseball, but an internationally known superstar. Yeah. So he's got international marketability here. We were talking with Kenny the Jet Smith about Victor Wembanyama before he even played one game in the NBA, saying that he is more marketable at this stage entering into the league than LeBron James because he already has that international presence even prior to getting to the league. And so Shohei Ohtani, he has that. He also, even within this superstardom, is looked at as somebody who's going to grow the economy of Los Angeles, and he's going to join some other powerhouses out there. I mean, it's showtime in LA all over again now that you've got Shohei Ohtani that's going to be out there. You've got LeBron James that's going to be out there. You got Bronny over at USC. I mean, you've got just some stars. Absolutely. I'm excited.
Nothing new for LA, though. There's always
excited.
a bunch of sluts. But yeah, I think this points to a lot of things. One, it's crazy just to wrap your head around the fact of how high these contracts are, especially when you take a look at a lot of the largest ones that have been reached over the last several years in the MLB for baseball. Two, though, what exactly it's going to do, not only for the local economy, but also just for the team in terms of the fandom, the selling out crowds, a lot of the excitement that is generated around one or two star players. Now that they do have Ohtani, the massive contract, $700 million over 10 years, the fact that they are banking on him for such a long period of time really shows, one, their belief in them, which I don't think is a huge surprise given the performance that he has put up over the last couple of years, but two, what it could mean for the organization down the line and how confident they are in Ohtani's ability to really further build LA Dodgers and exactly what the team's going to look like here for years to come.
I'm looking up nonstop flights from Asia Pacific to LA. I think that's going to be one area to keep your eye on right now. $1,000 for a nonstop flight right now. We'll see where that moves.
But Ohtani can afford a heck of a lot of those these
Yeah.
days. So yeah, exactly. No, you bring up a good point in terms of the international presence, international likability, and exactly what that does for a team. A massive opportunity. Okay, let's do a quick check of the markets. 90 minutes into the trading day. You're still looking at a pretty mixed picture, not too far from the flat line. You have the Nasdaq off about 0.1%. So off the lows of the session so far, you have the Dow up just over 100 points. Keep it right here on Yahoo Finance. More to come next hour.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blickery along with Diane King Hall. Here's what we're watching today. Macy's board is mulling over a $5.8 billion buyout offer, but its real estate holdings could be the real value for investors.
And key inflation data is on tap tomorrow. But what tends to happen with the markets around CPI reports? We'll discuss.
Plus, an IPO anniversary. We're going to speak with the CFO of Hilton 10 years after its public debut. How has the hospitality industry changed and what is still to come?
But first, let's take a look at how markets are trading in the early action. You've had a mixed market with the Dow on the plus side by just 0.3% up just over 100 points. The S&P 500 better by 7 points, up a little more than 0.1%. Nasdaq trading in the reverse direction, down 0.2%, down 20 points, 21 points at the moment. Investors kind of just trying to read the tea leaves ahead of the Fed's last meeting of the year. We'll do a quick check of the Treasury market, take a look at where yields are. Let's look at the 10-year in particular. You're looking at yields up 3 basis points there. So not a lot of action over in the bond market as well. So again, investors just really kind of cooling their heels ahead of the Fed's last meeting of the year.
Yep, last one. We got to talk retail because the Macy's board, they're mulling a $5.8 billion buyout offer. Though the retailer beat expectations in its recent quarter, large-scale department stores have had a tough go of it in recent years, struggling to compete as shoppers increasingly buy online. Another major name in the department store space, JCPenney, made headlines back in 2020 when it filed for bankruptcy and was taken private by a group of lenders. Though the two brands differ immensely, what can JCPenney's woes tell us about the possible path forward for Macy's? Yahoo Finance's Brooke DePalma joins us with more. Brooke, lay it out.
Good morning, Jared. Good morning, Diane. Certainly, there's lots to consider. I mean, both companies, Macy's and JCPenney's, both century-old companies. Macy's, 165 years old. JCPenney's, 121 years old. Now, both department stores really faced woes during the pandemic when e-commerce began to boom. We saw a tale of two different retailers, JCPenney's filing for bankruptcy and going private, while Macy's was approaching bankruptcy but avoided that after securing $4.5 billion in financing. Now, since JCPenney's has went private, we know that at the time back in 2020, they had a real estate portfolio of roughly 846 stores. Now that stands at roughly 670 stores. And when we spoke to the CEO of JCPenney's, he said that they're comfortable with that store portfolio and the size of their stores. And we know that they've been able to make over $1 billion investment to really remodel these stores as consumers continue to shop in store and online. Now, what's different here is that Macy's has a very robust real estate portfolio with what one analyst called a trophy asset being Herald Square. And what's different there is that real estate value, according to JP Morgan, is $8.5 billion. That Herald Square flagship could be worth at least $3 billion. And so many really focused on that billion-dollar real estate portfolio that it has, roughly more than 700 locations, more than 500 Macy's, more than 50 Bloomingdale's, and more than 100 Bluemercury stores. That's their cosmetic store. And really, we're looking forward to 2024. Macy's does have an incoming CEO, Tony Spring, who had come from Bloomingdale's. And he's really looking at a more profitable, leaner store portfolio. They have been leaning into that smaller footprint. And so really looking at this real estate portfolio as that prime asset that Macy's has going into this potential deal and or how it could stand out among other department stores that really haven't seen the current day. We're thinking Sears, Toys R Us inside Macy's. And so as department stores go behind the rearview mirror, how is Macy's moving into the forward with this robust real estate portfolio in mind?
They have a robust real estate portfolio. They do also, I mean, the difference between, say, a JCPenney and a Macy's, they've also got Bloomingdale's, right? So they do have
that little luxury retail asset to it.
Yes, they have some brand power. But in general, when you think about this, the changes in kind of consumer habits and consumer buying patterns, what does this tell you about where the consumer stands now, this kind of deal?
Yeah, well, speaking of what Macy's has under its belt, that Bluemercury, we continue to see a consumer that's leaning into beauty despite the pressure that they're up against. And so Macy's said in the last earnings call that they continued to see pressure up against their consumer. We also did hear of credit card rate delinquencies at Macy's rising. But when you think about JCPenney's, when we spoke to the CEO there, they said they're seeing a healthy
customer. They haven't seen a significant change to their customer. But as we look towards 2024, inflation still remains a key focus for consumers. They're also looking at alternative payment options. We see the increase of buy now, pay later, and ultimately e-commerce continues to see a boom. And so really here, it's how exactly Macy's will continue to bring customers in store, and promotions and value continue to be the name of the game as consumers just can't pay up like they used to.
Yeah, interesting stuff here. I mean, I definitely saw JCPenney coming. Macy's, you know, that's been in play before. We'll see what happens now. Brooke DePalma,
Absolutely.
Thank you. All right, an investor group has put forth a $5.8 billion bid for department store chain Macy's. Perhaps the most notable asset the company holds, its sizable real estate portfolio. Between the Macy's brand, Bloomingdale's, and Bluemercury, Macy's operates more than 700 locations, including its iconic Herald Square location. So where can the retailer win with its portfolio? We want to bring in Richard Kessenbaum, Triangle Capital co-founder and partner. So Richard, thanks so much for joining us. When you think about this deal, what does this tell you about where Macy's is in terms of the retail space?
Well, the consumer is changing, and consumers don't want to shop where their parents shopped. They want new venues, and that's been very challenging for the department store business. And so what you see is other people taking a different look at the assets of department stores and trying to figure out, how do we make this investment worthwhile? That may not mean that they grow or have a new formula for the department store business, as you guys have been very well describing. They may have a different strategy for the future of the brand. They haven't told us what that is, but it seems likely that that's the case.
Can we ask about valuation here? $5.8 billion. I've heard rumblings among various analysts that the number is a little bit low, and we don't know just yet, but it appears as though the buyer, the investment group, could be willing to pay a little bit more. Just what are your thoughts on this? What do you think in terms of the valuation? What does this deal look like?
I think they've come in with a premium that's not exceptionally high, and I would not be surprised if the bid goes up before it's over, if it does go forward, or that someone else comes in and makes a higher bid.
If someone else comes in, who could potentially come in as, say, even a dark horse bid, Richard?
Well, in most industries, you'd be looking for someone strategic. I would not expect that here. I think anybody who's in or knows the department store business has their hands full. And I'd expect another financial bidder, if there is going to be another bidder. I'm not saying that there is, but if there is, I would expect it to be another financial bidder.
Are we seeing now, are we just witnessing the ignominious decline of retail and a department store, traditional brick and mortar retail, and this is kind of one of the last gasps? How do you see this transaction fitting in with the broader trends within the real estate and department store landscape?
I think, Jared, it's not unlike your business. And what I mean by that is 20 years ago, we saw financial bidders buying up newspapers. That didn't mean the end of journalism. Here you are. But it did mean the decline of a certain way of conducting news and media that changed over time. And we're seeing that in retail. And when financial buyers come in, it's an outsider's view that allows changes to accelerate, as we saw in the media business.
And then, Richard, I want to ask you, big picture here, when you think about, say, as you mentioned, we've been watching the real estate landscape change tremendously. And right, young people, say Generation Z, are not shopping like millennials, boomers, Gen X, et cetera. So what does this mean, big picture, for the retail landscape? And also, I just want to think about the premium of the price that is being put on offer here. Could this actually even go higher?
Well, in terms of how consumers shop, what consumers want is personal values. They want to look at brands and companies and retailers and products and see their own personal values reflected in them. And they want to hear about the environment and sustainability and fair labor practices and local production and all the things that mean something to them. That's extremely hard to do if you're a department store because the assortment is so broad that it's hard to get personal. And the range of brands by design is meant to be encyclopedic. And that's not what consumers are looking for right now. So all of that fits into what consumers, with the decline in department stores fits into what consumers want now. So when you think about those personal values, it's not surprising that department stores are not as desirable as they once were. In terms of value, yeah, as I was saying a few minutes ago, I won't be surprised if the bid goes up or another bidder comes in, a financial bidder comes in at a higher value. I think the premium here is not extraordinary so far.
All right, we have to leave it there, but appreciate your insights. Richard Kestenbaum, Triangle Capital co-founder and partner.
Thanks, great to be with you.
We're watching shares of Paramount this morning. Shares of the media conglomerate sinking when it comes amid a New York Times report that Sherry Redstone, the daughter of late Paramount CEO Sumner Redstone, is looking to sell her stake in Paramount's parent company, National Amusements. Shares of Paramount popped last week on reports that Skydance and Redbird were exploring a possible takeover. And
this is something that's been talked about for a while, is the potential for Paramount to go to be a target for sale. Sherry Redstone has wanted to hold on to this property. New York Times saying that this is, though, the first time an offer has been seriously under consideration. One of the issues, obviously, has been the fractured ad market. That's been one of the challenges for the industry in general, but also debt obligations when it comes to Paramount.
Yeah, and real quick, if we go to the Wi-Fi Interactive, just want to chart what's going on here. This is our streaming landscape. This is my heat map that I've compiled. Don't take this as something that's comprehensive, but you can't even see Paramount. It's in the lower right, in fact, and that's because the market cap has dwindled. So to me, this looks like a forced sale. We did know about it, as you said, Diane. We knew about a month ago that something like this might happen. But here's Paramount over the last month, up 34%. We've seen a game of catch-up from a lot of the year's laggards, and a lot of these companies are enjoying the ride. So my point is, this deal was a lot cheaper a month ago, but we'll have to see. Maybe the timing is such that she feels she can get Sherry Redstone a little bit more money here.
All right, we've got more of your markets action ahead. Stay tuned. You are watching Yahoo Finance.
Stocks are mixed this Monday morning, but the market catalysts, well, they're really about to kick in tomorrow because we have CPI, Consumer Price Index data, and we're going to break down what this means for the market. Now, I have a chart here of the S&P 500 going all the way back, and that's in purple, by the way, going back to April of 2020. So you can see those pandemic lows there. What I've done with the cyan blue line is these are the CPI days. So the gains or losses in the stock market as represented by the SPY, which tracks the S&P 500. You can see these gains as they fluctuate with the overall market. Now, when we had the great bull market, and that was during the pandemic, we did see CPI days, they traded kind of flat. And then last year, when we had all those interest rate increases and we had that bear market, we did see CPI days trade to the downside. But importantly, last October, in fact, the day we were coming off the low, that big kick to kickstart this rally that we've had, that came with the CPI report. And in fact, this big gain here was not only matched, but exceeded a month later with a bigger gain. And so arguably, CPI has played a very important part in the rally this year. In fact, in the S&P 500 and SPY that tracks it, it accounts for about 5 percentage points of the gain, just those CPI days. So had you been in the market only on CPI days, you would be up 5% this year. So that's pretty significant, considering that we also have non-farm payrolls, that's on the employment front, and also the Fed. We have a meeting this week. Among those three, we really have the biggest drivers of the market this year. And by far, CPI has been the biggest driver of those three. Just want to go over real quick the sector action over the last month. We've seen a huge increase in real estate, consumer discretionary, that's retail. That kind of ties into some of these prices that we're going to be getting tomorrow that consumers face. Industrials, financials, materials, utilities. Basically a broad swath of sectors that were underperforming have suddenly perked up. And so that's kind of what we're facing going into the new year. Diane.
All right, that was a great breakdown as usual, Jared. All right, despite stocks' mixed picture this morning, markets have seen serious momentum within the last week as all three major indexes have finished the last 6 weeks with gains. But our next guest says she's not keen on chasing this rally, and maybe you shouldn't be either. We want to bring in Veronica Willis, investment strategy analyst at Wells Fargo Investment Institute, to weigh in here. So Veronica, talk to us about, so obviously we've seen some kind of FOMO action in play. And when you see something like that, what should we be wary of?
I think right now, the really big warning is what's going to happen with the economy. We're expecting the economy to continue weakening into early next year. And I think the market has priced in a different scenario. So there is some downside volatility potential there. I think it's going to be really hard to get this Goldilocks scenario that a lot of market participants are betting on, where the Fed is going to be able to ease, but the economy is still going to be okay. And I don't think that's the most likely scenario.
So if that's not the most likely scenario, how does an investor position themselves? How do investors get defensive in this kind of environment?
It's really smart to take that defensive positioning. Right now, we favor large cap over mid and small cap, and that's played out really well this year with the large cap space really outperforming mid and small cap equities. And from a sector perspective, we're a little defensive there as well. We like materials, we like industrials, and we like healthcare. Some of the areas that we think are going to perform well during an economic slowdown, just waiting until it's kind of time to turn into that cyclical early recovery type of positioning.
I want to ask you about the bond market, talking about safe sectors for your money. This 3-year stretch that we've had has really been a kind of a debacle for 60-40 investors. Is it finally time to start wading into the bond market again? What do you see for the new year, especially considering that we've already seen this huge run up over the last month, kind of a game of catch up in bonds?
Yeah, so for those investors who have an objective of income, the bond market is actually a good place for you right now because you've got those higher yields that we haven't experienced in decades. But then for those 60-40 types of investors, we really have been kind of encouraging exposure to some areas outside of the traditional stocks and bond market to give you a little bit of that diversification. So thinking of the commodities area, thinking of some alternatives to help protect you when bond prices rise as the yields go higher. But then looking into next year, We do think the Fed will eventually be able to cut rates. Yields will come down, and that will benefit those bond investors. So getting in now while you're able to get those attractive yields, remembering that if you're holding that bond to maturity, you've got that steady income, but then you also will get that principal back when the term expires.
So we know Wall Street's on Fed watch this week, of course, for the last meeting of the year. Veronica, what are you thinking, or how are you positioning in 2024 in particular in terms of when the Fed would start cutting?
I think when we see the evidence that the economy is actually slowing, that's when there can be a little bit more confidence that the Fed will start to cut. Right now, the economy is still doing okay, so it doesn't seem likely that the Fed will start to ease, while it appears that consumers and the labor market can handle the current level of rates. And we've heard some commentary from Fed officials to that effect. I think it'll be really key to see what Fed officials are saying, if this is going to be more of a hawkish hold at this December, or are they going to start being a little bit more dovish with their language?
Let me ask you before we go, got time for one more. We've been talking a lot about the bond market, but also want to talk about some of your portfolio recommendations for the new year. So where do you see 2024 evolving, and what kind of sectors are you looking at for the new year?
We recently released our 2024 outlook, and we talk a lot in that outlook about the tale of two halves, where in the first half of the year, you want to be positioned to be defensive. So that's where we like large cap over small cap, and we like the healthcare, materials, industrial sectors. And then eventually the economy will start to recover, and that's when we'll take more of a cyclical bent, where maybe small caps will start to outperform in that early recovery stage.
All right, have to leave it there. Really appreciate your insights. Veronica Willis, investment strategy analyst at Wells Fargo Investment Institute. All your markets action is straight ahead. Stay tuned. You're watching Yahoo Finance.
Another deal in the oil and gas space. Occidental Petroleum is buying Crown Rock for roughly $12 billion, a deal expected to close in the first quarter of 2024. This comes after several energy consolidations this year, including Exxon buying Pioneer and Chevron acquiring Hess. Our next guest has been calling for just this sort of consolidation in the industry, and he was betting big on Occidental. His firm's largest holding in its portfolio is the petroleum company. To break down what's going on in the sector, we want to bring in Cole Smead, CEO of Smead Capital Management. Cole, thanks so much for joining us as usual. It wouldn't be Merger Monday without a deal to talk about, right? So let's just jump right into this latest. What does this, there has been obviously a lot of consolidation this year. What does this say about kind of the state of the industry now?
Yeah, thanks for having me. What it says is that there are assets out there that you can buy more attractively than your own company stock. And that's, use this as a private to public transaction. In effect, these assets are going public into Oxy stock at the same time. And we're going to continue to see these arbitrage. There's not a ton of deals like this, but from a private to public, but there's a lot of public to public that has to go on to. We're probably going to end the 2020s with 10 oil companies in America. And so just do the math of where we got to go from point A to point B to get to that. But again, let's say Oxy, most of this deal is going to be done on debt. They're going to borrow that money at, say, 7 to 8%. Their free cash flow yield on the assets they're buying is higher than that. So they're just fixing in their costs. They're going to collect the spread in between, pay off this, and the little equity they are floating, they'll buy back within 1 year of free cash. So as shareholders, our hands are applauding and very excited about what Vicky's doing.
And Cole, there's a Berkshire Hathaway Warren Buffett angle to this. Occidental Petroleum, one of Berkshire Hathaway's largest position, or I should say one of the largest positions in the company. And an interesting paragraph here I'm reading in a Bloomberg article has to do with the nexus between Occidental and Warren Buffett. In the run-up to the deal, Occidental's corporate jet flew from Houston, where company headquarters is located, to Omaha, Warren Buffett's home, on November 27th, and they stayed grounded for about 3 hours. It was the second time Oxy's jet visited Omaha in November, having not previously made this trip since May, flight data show. So this almost seems to be a regular thing. Can you talk about the relationship between Berkshire Hathaway, Warren Buffett, and Occidental Petroleum?
Yeah, well, it's a lot like having a private partner in a business. Buffett owns, well over 30% of the business. So if you had a large shareholder like that and you're going to go out and do a transaction where you're going to be borrowing money, would you go to them and tell them what you're doing? The answer is you obviously would do that. And they're just treating them like a large tenant shareholder for the stock. And they should, because obviously Warren not only has provided capital at times, but he's also owning so much of the business. So I think that makes a lot of sense. You got to remember, too, that Buffett said at the Berkshire meeting that he doesn't have a plan to acquire Oxy. So I think that's the other thing you got to take against it. In other words, he really likes being a public shareholder. Doesn't mean he can't buy more from the public. He's on a FERC approval basis. He's approved up to 50%. If he'd like to go above that, he'd have to go get federal approval for that. But I just say it because it doesn't preclude him from buying more stock today. And obviously, like you're pointing out, Vicky's going to call him when she's going to do a deal, and she's going to at least communicate with him as shareholder as a minimum. But wouldn't you love to be a fly on the wall in that office that day?
Yes, indeed. Wouldn't we all? All right, Cole, you talked about all the debt that's involved in this deal. What's the risk when you think about all that leverage?
The risk is that if you're standing there watching Oxy do this deal, you're asking yourself as an oil and gas company, why are they so much more optimistic about the future than everyone else? If you go look at the deal terms, it's a $12 billion deal. I think it was like 1.7 billion was going to be in equity. So most of this is debt. That seems very risky to most people, and yet you'd have to be very optimistic about the future. Posit that against what you're seeing in the public equity markets. Many of these stocks are down 20% in the last month, depending on which stocks you look at in the oil and gas space. So I think they have a very bright vision of the future. Obviously, Warren wouldn't. Otherwise, why would you own the stock to the tune he does? And I just don't think you find that across the oil and gas business. It's almost like all these oil and gas executives, which tend to be a machismo business, have lost all their chutzpah. Like, where has that gone? Why is Vicky dominating the aggression subject? And we applaud her for that. That's to her credit and all of her colleagues at Oxy. This is a great deal, and they're going to go out and win the day. They'll be one of those 10. And the question is, who else will be one of those 10 in a decade?
Well, let me ask you, is the field still ripe for M&A deals here? Who's left, and how sizable are the deals? Might we get another surprise next Monday or some Monday in the new year?
Yeah, there's already discussions. I mean, Endeavor's another private company out there being talked about that could have a transaction like this go on. So this will continue, but even, where you're going to see the deals right now, this is a classic example, single basin operator, right? They're in the Permian, in Midland. That is a single basin. Where we're going to see the next evolution is after we clear out all the single basin producers is we're going to go on to multi-basin producers who can get scale where they cover 2 or 3 of the geographies that they have in common with someone else. And that will be the next evolution of this. But we really got to consolidate the single basin producers. Who should be doing this? I mean, if I'm the majors, I'm calling my banker saying, look, we want to be next. But again, they wouldn't probably be doing this with debt like Vicky is because they'd be doing all stock deals like they have been. We think this debt deal is the right deal.
Great comments here, and a shout out to Vicky several times over for having the chutzpah to put this together once again. Thank you for joining us. Cole Smead of Smead Capital. Yahoo Finance's Company of the Year is Danish pharmaceutical giant Novo Nordisk. The company is unique not only for its products that have now revolutionized the healthcare space, but also for their interesting company structure. Yahoo Finance reporter Ali Garfinkel is here to break down exactly what makes Novo Nordisk so special.
Jared, good morning. Investors out there, I have a bit of a riddle for you. What do Ozempic and Legos have in common? Yes, okay, they're both from Denmark. You probably knew that. However, what you may not know is that they are both also controlled by a foundation primarily. Now, that's exactly what it sounds like. It's a charitable entity focused on the public good. And this is a system that's actually pretty common in Danish capitalism. So you get a sense of what we're talking about here. The Novo Nordisk Foundation holds 28% of shares of the company, but 77% of the voting power. Now, for private investors and institutional investors, those numbers are going to be essentially reversed. Now, for my tech investors out there, this might be sounding a little bit familiar to you. And that's because this structure is fundamentally similar in many ways to a model we have here in the United States. And that model is called the dual class system. Now, you mostly see it in tech companies. Meta, Shopify, Alphabet are all examples. And it is pretty controversial. It's a system where there are Class A shares and Class B shares. The Class A shares have more voting power and are less common, usually reserved for founders, and Class B shares are available on the public markets and have less voting power. Now, there are pros and cons here. I've talked to a lot of advocates, a lot of critics, and the arguments sort of boil down to this. Advocates will say that it's stability. Dual-class system insulates a company from short-term concerns, short sellers, corporate raiders. All of those are not going to be concerns in a dual-class system. However, a lot of critics will say that it actually insulates the company from real criticism, insulates the company from change, and often will concentrate power in just too few hands. Now, what should investors make of this in the case of Novo Nordisk? It's sort of a unique situation because it's a foundation. However, there are things to just know. Number one, it's a pretty inherently risky structure, a lot of people will say. Even though Novo Nordisk has done incredibly well, it's something investors should absolutely be aware of. It's also something where investors should know about the foundation itself, the foundation that's making a lot of these decisions. The foundation's primary objectives, notably, are not growth. They are stability and supporting scientific and humanitarian causes. So that's a thing to keep in mind. Experts say ultimately, though, that no one should discount Novo Nordisk because of this structure. They should just be aware, come in eyes wide open, because they're benefiting from a pretty simple reality here, and it's that it's hard to argue with success. Diane, Jared?
Oh, Ali Garfinkel, great reporting as usual. All right, Novo Nordisk became Europe's most valuable company this year thanks to the seemingly overnight popularity of its drugs, Ozempic and Wegovy. So it's no surprise that we named the Danish pharmaceutical giant as our Company of the Year for 2023. Yahoo Finance health reporter Anjali Kimlani was able to sit down with Novo Nordisk CEO Lars Jorgensen to discuss being named Company of the Year, the company's recent success, and more. Let's listen.
It's a good point that a company to stay really on a sustainable growth track, you have to have continuous innovation. And in our industry, when products have been on the market for some time and you face patent expiration or healthcare reforms, typically there'll be pressure on pricing. So we see now that our long-time short-acting insulin family of products in the US is now being included in this, new approach to negotiate pricing by the government. And we'll have other products potentially in the future being included in that. But what we are focused on in Novo Nordisk is really to continuously drive innovation. And as long as you succeed in being innovative in our industry, you'll be adding value based on bringing better and better versions of your prior products. And that's the way to get to more patients and also protect value because you bring a better offering. So whether it's always bringing complications when you have to face government interventions and negotiations, it just underlines the importance of having a strong strategy that's focused on bringing better and better products to patients. And if you succeed with doing that, then you have the growth trajectory of what we see in Novo Nordisk today. And a company that's even turning 100 years can still be in its strongest position because over decades, continued innovation has led to stronger and stronger medicines. So yes, it's a challenge to deal with, but it's also a call for just having a continued focus on how we as a company add value, and that's via our scientists, the innovation we bring to patients.
I wonder, you're now at this juncture where you finally got to the finish line on finding the sweet spot, that magic number that everyone's happy with in terms of the weight loss. And you've talked a lot about how all of this is because of where we are in society today, how we live, what we do, and how it's different from, when you were younger. So we've seen a lot of sort of doomsday predictions for other sectors as a result of the success of this drug or these drugs. What do you think about that? There's everything from food and beverage to airlines, clothing, apparel, potential gambling and addiction benefits. How do you think that that's going to pan out? Do you think it's really going to have that much of an impact?
Yeah, it's a great question, and it's really fascinating for us to reflect on how big an impact we might have. So when it comes to consumption of fuel for airlines, some of the medtech companies involved in sleep apnea, dialysis, to drinks and snacks companies, etc. I think there'll be an impact that is coming over many years. So I think it's maybe a bit dramatic what is being depicted right now. But of course, it reflects that when you assess the value of a company and you discount the future cash flows to today's value, it's of course the impact over many years that's then reflected in today's price, and then you see sudden reactions. So my view is that some of those reactions are perhaps a bit exaggerated, but there's no doubt that with the intervention we see now with the GLP-1 based medicines, you see significant shift in consumer behavior, and some of these categories will be impacted. I think it's gradual or quite some time. So my base view is that it's perhaps a bit of an overreaction, but I take it as a strong sign of what is it actually, the power of the medicine we're introducing now is having on society, which of course is then also leading to that there is a strong case in actually paying for that innovation coming from Novo Nordisk.
Absolutely. Do you think that with the result from the SELECT trial, for the cardiovascular benefit, does this now open the door for more M&A in different disease areas for the company? You've really had such a year. What are you thinking about?
Yeah, it's a good point that we can see that when we take our molecule into new settings like cardiovascular disease, you're also touching upon kidney disease and other adjacent disease areas. That means that we are expanding our growth platform, and we have a disciplined way of expanding. So we follow a molecule to a new market, and then we can start building there. So we are right now looking for assets and acquiring and in-licensing assets in the cardiometabolic space. So it's the development of semaglutide in first diabetes and obesity, and the broader application of that creates a platform for us then to do non-organic deals and acquire innovation from outside and really complement and bolster our position in new therapeutic areas. And I think that's a very interesting growth strategy. And it's also needed as Novo Nordisk has to replenish our pipeline going forward, and that takes more and more assets But we're starting early, and I'm quite optimistic in terms of how we can build value by taking early assets in and then add value to those assets, and thereby value to our shareholders, compared to if you buy marketed products or late-stage assets, you typically have to pay fully up, and there's limited return to our shareholders. So we would like to do it early, add value to it, and take the risk, and hopefully also the earnings that come from that.
A big thanks to our very own Anjali Khemlani for that interview with Lars Jorgensen, Novo Nordisk CEO. We've got more of your markets action ahead. Stay tuned. You're watching Yahoo Finance.
The U.S. vetoed a United Nations resolution on Friday that called for an immediate humanitarian ceasefire in Gaza. The resolution was backed by almost all the other Security Council members and dozens of other nations. And now the UN's Relief and Works Agency for Palestine refugees, they say it feels abandoned by the international community. A CBS News poll shows that a majority of Americans do not approve of President Biden's handling of the Israel-Hamas conflict, with that rating falling to 39% from 44% in October. So what does this mean for the president going forward? Yahoo Finance's Rick Newman joins us now. So Rick, any fallout here?
Biden cannot win on this issue. So there's one poll that shows a majority of Americans support Israel in this war. Biden has been a visible and a vocal Israel supporter. And yet there's that poll you just pointed to, Jared, where only 39% of Americans say they approve of Biden's handling of the war. I mean, if you're Biden, you must be wondering, what am I supposed to do here? I mean, this has been very divisive in the United States and elsewhere, obviously. I think one of the things that is kind of enlightening is that young people in the United States seem more aware than a lot of people may have expected of the plight of Palestinians, basically homeless in the Middle East and in Israel, and Israeli policies of settlers encroaching on Palestinian land and stuff like that. I mean, this seems like an arcane matter in a distant land, and yet a lot of American young people seem to be very aware of what's going on here. So I guess if there's any good news for Biden in all of this, is that this is foreign policy. This is not what usually motivates voters during an election. So maybe this is not going to cost Biden a lot of votes, but people don't like the way this is going.
Sure, Rick, yes, you make the point about it being foreign policy. However, you're dealing with the issue of anti-Semitism that's coming into play here, and tackling it has become just really even more pressing in the aftermath, or I should say during this conflict between Israel and Hamas. It's really embroiled some of the nation's most prestigious universities. We want to include, of course, the Ivies. We know that the University of Pennsylvania's president, Liz McGill, resigned on Saturday amid pressure from donors. There were a lot of issues there. Talk us through what the story is there, Rick.
Well, this follows this hearing on Capitol Hill last Tuesday, I believe. And the problem that these university presidents, not just the Ivy League, man, it's everywhere, is how to deal with anti-Semitism, how much to tolerate, basically. And the sort of cringy moment in that hearing, one of the members of Congress asked the president of Penn, all of them really, if you have students who are calling for the genocide of Israel, is that tolerable? Or should they be punished for that? And Liz McGill said it is context dependent. And that just was such a wishy-washy answer. I mean, it's kind of like, it almost sounds like you should be allowed to say anything and there should be no payback for anything that happens. So there was already a lot of unhappiness about how she was handling this. A lot of prominent donors, including Mark Rowan, who's the CEO of Apollo, Yahoo's parent company, they were threatening to withdraw literally hundreds of millions of dollars in Penn. So finally, it just piled up, and it seemed like she had to go over the weekend. So I guess all those donations are safe for now, but whoever comes in to replace her is going to be dealing with all the same problems. Meanwhile, we're waiting to see if the president of Harvard meets a similar fate. The president of MIT also was at that hearing, also on the hot seat. So this is going to go on for some time.
In a very delicate situation going to be moving into the new year for sure. Thank you for that, Rick Newman.
Bye, guys.
Alibaba is no longer China's most valuable e-commerce company. It actually owned that title for nearly a decade. That title now goes to Pinduoduo, or PDD. That is a parent company to the shopping app Temu. The company has been around for less than a decade, but is making big waves in the e-commerce space, surpassing not only Alibaba, but its other Chinese counterparts. Just in the past year, U.S. spending on Temu has already surpassed Shein. Shein?
Sorry. I know, it's a woman thing.
I thought it was Shine or Sheen, but hey, I'll go either way. And yes. Temu is attracting more monthly customers as well, increasing its lead over Shein,
yes.
Shein every month. I'll get it by the end of this segment.
I know.
But can Pinduoduo keep the momentum going? I want to go.
Go ahead.
I want to go to the Wi-Fi Interactive. Yes. I just want to show. This is our Chinese heat map, and this shows Pinduoduo with a $188 billion. I guess market capitalization here, trumping Alibaba by about $7 billion, and nothing else is really even close.
Yeah, I mean, Pinduoduo, parent company, or PDD, parent company of Temu, has seen its stock surge this year. I mean, it's come after Shein's market. And just continued to outstrip it month after month after month. I mean, when you look at it, it first beat out Shein back in May. And, you know, it's not just women who shop on the platform. And I actually currently don't use either platform, but I've followed both of these companies, these e-commerce companies that have taken on the likes of Amazon and have outstripped them when you think about the type of sales.
Have you used Temu at all?
I have not used it, but here's the thing. That's one of the things that Temu is doing that's different than, say, a Shein is they use a social aspect to how users use their platform. So that's some of the pull and lure in terms of this. And again, I mean, we've seen the stock surge where you look at the ADR, especially in particular this year for Temu. I mean, it's up, what is it, more than 60% for the year to date.
You bet.
So it's gained a lot of market share. Yes. But Shein is also reportedly planning to come to the public market here in the U.S. So we'll see what happens with Shein.
Yeah, it could be one of the big IPOs of the new year, a couple of those that we're tracking. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
In the decade since its public debut, Hilton has expanded its footprint across the hospitality industry. The hotel brand has grown its property count by 80% and added nearly 500,000 rooms. With the stock up nearly 300% since its IPO, what's next for the brand? For more on this, I'm joined by Hilton CFO Kevin Jacobs. Kevin, great to catch some of your time here on the day. Milestone occasion for Hilton here. When you take us back through the years and what's been core and catalyst to some of that growth over time, what is that next leg of growth that you're going to lean into?
Yeah, hey Brad, thanks for having me. It's great to be with you. And yeah, we're celebrating today 10 years since our IPO. It's amazing. It seems like you don't know where the time has gone, but you mentioned it. We've doubled our brand portfolio in that time, nearly doubled the size of the company. We continue to grow rapidly. So the next phase of growth is we're opening more than a hotel a day. We have a development pipeline of nearly 460,000 rooms, more rooms under construction than any other hotel company. And, it's really, a lot of it's been fueled by, our success has been fueled by our culture, since we were acquired by Blackstone and taken private in 2007. And everything we've done since then has been driven by our team members around the world and our culture. And we were just recently named the #1 great place to work in the world by Great Place to Work and Fortune. So we're really proud of that. And as you mentioned, we're really proud of our returns. So since our IPO 10 years ago, our total shareholder return has been about 330%, which has far outpaced the Dow Jones, the S&P 500, and our peer set.
Yeah, absolutely. I mean, when you talk about that room base that's under construction right now and the capacity that's set to come online of about 460,000 rooms, half of that currently under construction as of the last earnings call, and you discussed that on that call. When you think about the costs that you were anticipating going into starting a lot of these projects, that's kind of moved given the credit conditions and a lot of what for construction given the credit conditions and a lot of this going forward here. So ultimately, where do you see some of those costs also comparing over a long-term basis?
Yeah, look, construction costs, the raw materials costs have actually moderated a little bit. I mean, they were going up in 2021, 2022, 20 to 30% a year. And those cost increases have moderated. But of course, as you've alluded to, the cost of capital is higher. And so, that's actually causing is a little bit of a constrained environment for development, which helps fundamentals, right? Because if capacity additions are lower, then fundamentals are good. And then for us, with our brands being as strong as they are, we're continuing to take share. So we're getting under construction more than our fair share of projects. And that's because our brands are financeable and our owners think that they're more likely to have success with our brands. So actually year to date through the third quarter, our construction starts are up over 20% globally, 18% in the US. So a lot of our hotel owners are saying, look, I know my construction loan's gonna cost me more, but fundamentals are good. I like the Hilton brands. I'd rather get under construction now and open up into a good fundamental environment in the future, which is really fueling our construction costs, our construction starts, to continue to go up despite an environment that is a little bit more expensive.
Kevin, let's talk a little bit more about that environment just briefly here. I mean, revenge travel, do you believe that's behind us? And if so, is 2024 a year of normalization?
I think in some ways things have normalized. I think it depends on how you characterize it. There's still a lot of pent-up demand for travel from COVID. Obviously, during COVID, people, focused on acquiring goods, because they couldn't move around as much. And now people are focusing more on experiences. And so the recovery has been led by leisure, leisure demand continues to be robust. We expect a really strong holiday season coming up, and we expect leisure travel to continue into next year. And I don't know that you would characterize it as revenge travel, but business travel, which of course everybody wrote off during the pandemic and said it was never going to come back, is now back to just about where it was from a volume perspective and above where it was in 2019 from a revenue perspective. And then meetings and events are coming on strong. So our group business, our group position for next year is up almost 20%. And so if you think about people being, a little bit more flexible in their work environment, maybe not in the office as much, people need to meet more. So I don't know that I'd call it revenge, but I think I'd still refer to it as a lot of pent-up demand for travel through COVID. So, our outlook for the environment for next year, even though most people are calling for the economy to slow a little bit. We feel really good about the demand and the overall fundamental setup for our business next year.
Kevin, I got to hustle to my finish here, but just lastly, when you've got the amount of Hilton Honors members that you do, you were talking most recently about growth of 19% year over year in the most recent quarter, hitting 173 million members, fastest growing hotel loyalty program here. That's a lot of people looking for premium experiences and products. Do you anticipate needing to change the scales, change that type of kind of membership makeup or the rewards that people see as a result of that demand?
No, look, we're constantly evolving the value proposition of our loyalty program. It's been a huge driver of our growth. You mentioned 173 million members. That's quadruple what it was 10 years ago when we IPO'd. And so we feel really good about the value proposition. Like I said, we're constantly tweaking it and using, the combination of great physical service and digital technology to have a better relationship with those members. And those members really drive our growth, and they'll continue to.
Kevin Jacobs, Hilton CFO, congratulations on this milestone for the company.
Thanks, Brad. Thanks for having me.
Absolutely. And that's all for us here on Yahoo Finance. For Jared Blickery, Diane King-Hall, and Brad Smith.